Good morning, everyone. So again, I'm Kirsten Faulkner, and I'm the Executive Director of Historic Hawaii Foundation. So thank you all for coming out on this rainy morning to learn about historic tax credits. We are doing this as a hybrid presentation. So in addition to being here in the room, we also have several people online, and we're going to try to engage with both people in real life and virtually, and this will be a bit of an experiment for us. We'll see how it goes. But we're really happy that people are making time to do this and to learn more about tax credits for rehabilitation of historic properties. So this is a co-production between several organizations. Historic Hawaii Foundation is a statewide nonprofit organization that works to preserve historic places across the Hawaiian Islands. So we have been engaged in historic preservation work for about 50 years. Next year is our 50th anniversary, founded in 1974. And in addition to me, the executive director, we're joined by Andrea Nandoskar, who's our education program manager. There's Andrea. And Michelle Kizik, who is our development associate. And they are both here to help as well. We've been pleased to be partnering with the Hawaii State Historic Preservation Division on this presentation. Jessica Puff is the Architecture Branch Chief, and she'll be presenting later on. The State Historic Preservation Division is sometimes abbreviated as SHPD or SHPD. So if you hear people talking about SHPD, they're not talking about maritime heritage. They're talking about a state agency. The State Historic Preservation Division is part of the Department of Land and Natural Resources for the state of Hawaii. And SHPD is responsible for implementation of federal and state laws related to historic properties and cultural resources, including implementation of the historic tax credits. This is also a cooperative presentation with the National Park Service. We have two members of NPS helping out. One of our speakers is John Sandor, who is with the Preservation Technical Services. He's joining us from Washington, D.C. And then we also have Dr. Elaine Jackson-Rotondo, who's with the Western Regional Office. She was supposed to be here in person, but had some flight delays from San Francisco. So she's actually joining us online and will be helping with monitoring and moderating the online folks. We have been able to get certified continuing education credits for both AICP through the Hawaii chapter of the American Planning Association. So anyone who needs AICP credits, you can self-certify those through the certificate maintenance log program, just in the normal way. So we thank APA Hawaii for supporting continuing education for planning professionals. It is also approved by the American Institute of Architects for 3 AIA CES credits. So if you are an architect who wants to get credit for this class, you need to be sure to sign the log if you're here in person with your name and your AIA number. And if you're online, the pop-up survey at the end of this course will include a question of, are you looking for AIA credits? And if so, enter your AIA number and name. So be sure to do that on the separate web page after the webinar ends. So some of our speakers today, I already mentioned Dr. Jackson-Rotondo, who will, instead of being here in person speaking, she's going to be helping out with the online moderation. Me, you've already met. I'm the Executive Director of Historic Hawaii Foundation. John Sandor will be giving a presentation about the federal historic tax credit. And then Jessica Puff, sorry, this mic keeps coming in and out. Jessica Puff will be giving the presentation about the Hawaii state tax credit. Following both of them, we have Shelby Mendez, who is with the architecture firm of FAI, formerly known as Fung Associates, and she will be presenting a case study for us for the Dearborn Chemical Building, which is located in Kaka'ako here on Oahu. And then John Lee will be giving more of the advanced level information on more advanced concepts, including syndication tax credits and joining historic tax credits with low-income affordable housing tax credits. So we're really looking forward to taking that kind of deeper dive in some of those unique situations. And then following John, we have Mark Hashem, who's going to be giving a case study on the Hocking building in Chinatown here on Oahu, which did combine those tax credits of historic and low-income affordable housing. So it's a full lineup, but we think it's some really great information, and we hope it gives a lot of the dimension and perspectives on how these tax credits work. We are planning on being here for 3 hours today. We're scheduled to go until noon. We'll take some breaks along the way, but we really want to get through all of the material. We're going to be talking about, eligibility requirements, application procedures, basic concepts like what is a certified historic structure, how do you apply the standards and guidelines, what are qualified expenses, some of those really key concepts, and then also some financing strategies. I mentioned this webinar is being recorded, and we will have both the recording and this slideshow posted to historichawaii.org. So you don't have to be frantically taking pictures of slides or anything. We will make this available immediately, within a day or two following today's class. Let's see. And then for people who are online, we ask you to just use the chat box to enter any questions or comments, and we'll be monitoring that as we go, and we'll be sharing out some of those questions when we get to the Q&A portion. We're hoping to reserve a lot of time for discussion towards the end of the class, but we want to get through the basic material first, so that might answer some of your questions, and then we can use the Q&A to really talk about any other situations. So, questions on that? That was all the, intro stuff. All right, I'm just going to keep going. So, thinking about what are we even talking about here? What is the purpose, the need, the objectives, the impacts of historic tax credits? So historic tax credits were first established at the federal level in 1976. First, it was a depreciation incentive, and then in 1981, it became a tax credit. And the tax credit set this foundation for spurring private investment in the rehabilitation of the nation's historic buildings. And it was really seen as a way to provide an incentive for private investment in the revitalization of America's heritage. So it's independent. There's two federal agencies that are responsible for different aspects of tax credit. The first one is the National Park Service, which looks at the historic preservation side of, what is the actual project, and are you following all the standards for historic preservation? And then the Internal Revenue Service interprets and administers the tax part of the code. So those two departments need to work together to make this work. And today we're mostly hearing about the NPS, historic preservation side of the house. But we are going to talk a little bit about how the tax side works, but this is not financial or legal advice. And if you need financial or legal advice, please consult your accountant and your lawyer. This is really to give you the overview and the understanding of the program and the process, but it's not for specific individual projects. You still need to consult with professionals when you are trying to do an actual project. So just a quick overview on tax credits versus tax deductions. Basically, they both reduce your tax bill, but they do it in different ways. A tax credit reduces your tax liability on a dollar for dollar basis, where a tax deduction reduces your taxable income. So if you look at the example here, if you have $100,000 of income, and a tax deduction of, say, $10,000. So a deduction would be things like a charitable contribution to a nonprofit organization like Historic Hawaii Foundation. And so you would take that deduction, and now your taxable income would be $90,000. If there's a tax rate of, just in this example, 25%, which, your tax rates vary, but if the tax rate of 25% is applied to that $90,000, the calculated tax is $22,500. So your tax bill is $22,500. On the other hand, with that same $100,000 in income, no deductions, so your taxable income is $100,000, same tax rate of 25%, so your tax would be $25,000. But then you apply the tax credit of $10,000, so it's $1 for dollar, and now your tax bill is $15,000. So both the deduction and the credit provide a reduction in the tax due, but the credit is more impactful because it's dollar for dollar instead of that sliding scale. So the historic tax credits are credits, whereas things like a preservation easement incentive for historic preservation is a deduction. They both provide incentives for preservation, but again, the calculation is a little bit different. So what are we trying to do here? The Historic Tax Credit Program is to promote historic preservation and community revitalization through historic rehabilitation. And looking at the objectives, we're looking at community redevelopment, revitalizing older and depressed communities, preserving mostly through adaptive use of historic buildings, and prompting economic growth. The National Park Service does an annual report and looks at, just counting how many projects are done and what's their calculated value and how many housing units. And they've tried to quantify this impact in terms of jobs, economic activity, property values, affordable housing, revenue generation for local governments, and has found that this program, since it started in the 1970s, it's been incredibly instrumental in preserving historic buildings and places, as well as both urban and rural, that provide special character and attract new private development. So it's pretty interesting to see, 40 years of data that underlies, how effective these programs have been. So just last year, in fiscal year 2022, there were about 1,400 Part 1 applications, and we'll learn more about Parts 1, 2, and 3. So these are the stages in this program. About 1,200 or so Part 2 certifications, and about 860 certifications of completed work. What I found interesting about some of this data is that there's a range of size of projects. About 25% are over, 26% are over $5 million, but 75% are under $5 million. So they've got this real range of size, of scope, and scale. They apply to both rural and urban, and they've also been used. Over $6.56 billion in private investment in a single year. And then if you look at the cumulative impact since the program began, we're looking at about $123 billion of rehabilitation investment across the country. 48,000 projects have been certified. And that includes about 308,000 rehabilitated housing units and about 343 new housing units. So it really is prompting housing, and a lot of those are low and moderate income as well, which is pretty exciting. Rutgers University has been working with National Park Service for many years to do economic studies so in addition to saying, hey, yeah, this is great for our communities, it provides a lot of benefits, they're also saying, well, can we quantify the money side of things? And, these numbers are pretty impressive, but $7.3 billion in rehabilitation investment, 122,000 jobs, and that includes 42,000 in construction, 27,000 in manufacturing. So there's this interconnectedness, between labor, materials, economic generation. Let's see. So again, just cumulative effect over the last, 35, 40 years, includes 181 billion in rehabilitation investment, almost 3 million new jobs. One of the interesting things about tax credits is there's other tax credits. There's other federal and state programs that support tax incentives for certain public benefits or public goods. So the question is, how does this one stack up? How is it compared to other kinds of economic primers for non-preservation investments? And those same studies by Rutgers University showed that the return on this initial investment is 5 to 6 times what that initial, foregone taxable income is. So a 5 to 6 time return on investment is, considered pretty good. So it's really considered to be one of the strongest tax credit programs at the federal level. But not all states participate equally in this. And so, it's available in all the states and territories, but not every state participates at the same level. And Hawaii has historically been much, much, much slower and less participatory than many other states. So you can see, kind of where we stack up. These are states alphabetically, not by level of activity. But in fiscal 2022, Hawaii only had a single project. And in the last 5 years, there's only been 4. So it's really not participating at the level that we'd really like to see. And, because of that, we also don't realize the same benefits as some of the other states and some of the other areas. Over the past 5-year period, we saw about $8 million in total rehabilitation costs, and that created about 106 jobs. So, that's not nothing, 100 jobs, $8 million, but it would be nice to really kind of up that level, up the game. So one of the things one of the reasons we're offering this class is to provide this information and provide this encouragement for people to investigate this. One of the main differentiation between states that participate and states that don't is whether or not they have a state level income tax credit that can be used concurrently or in combination with the federal tax credit. New Mexico enacted the nation's first state historic tax credit in 1984. And since then, about 70% of the states have added their own state level tax credit. So about 37 states, I think, currently. State of Hawaii offers a historic preservation income tax credit that took effect on July 1st, 2019, and it was authorized for 5 years. So unless it's reauthorized by the legislature in this coming session, it will sunset on June 30th of 2024. So it's been in effect for 4.5 years. It's kind of had a slow start, but Jessica Puff from Shifty is going to be talking more about how it's structured and how it works. And our hope is that it will be reauthorized, and when the legislature introduces the bill and holds hearings, it would be helpful for them to hear from people that they think this is something that would be of benefit to us. So again, why do we do this? For one thing, it makes historic preservation more financially feasible. It's expensive to take care of a historic property, and banks get really kind of concerned and confused about complicated projects. So, they lend fewer dollars to historic preservation projects versus new construction. So these incentives really help fill that financing gap and can make these projects more feasible. And preservation overall, not just when you're using tax credits, but doing it at all, tends to create more local jobs, and especially high wage local jobs, than new construction. And a lot of that is because historic preservation tends to be 60% labor versus 40% materials, where new construction is the reverse, 60% materials, 40% labor. So when you're investing in a historic preservation project, you're hiring more local labor. And so it becomes the job creation tool. It becomes high skilled labor, high wage labor. And so that keeps the money local, which is always a good thing for a community. It increases, the number of rehabilitation projects happening in an area, in a state. It attracts private capital. So those are all, great incentives. It provides a leverage for that private investment, and that can lead to other community outcomes, such as housing. And, Hawaii has a housing crisis. I don't think anyone is going to be shocked by that news. So there's got to be a lot more creativity and a lot more interested ways to find solutions that fit in our community and aren't just kind of pushed down your throat over everyone's objections. And rehabilitation of historic properties are a great way to do that. Preservation conserves energy and resources. It supports revitalization of main streets, walkable neighborhoods, and it's just generally good for our communities. So you're not going to be surprised that the executive director of Historic Hawaii Foundation is saying historic preservation is good, but I'm assuming that all of you agree because you're here. So we're really excited about this opportunity to learn more and to really explore this tool as a way forward. So with that introduction, I'm going to turn it over to John Sandor, who's going to take us through the federal historic rehabilitation tax credits. And following John, we will have Jessica Puff about the state credits. We have one question before we go. Go ahead.
Just a quick question. I did come in late, but is there any reason why Hawaii has such low participation?
Okay, so the question for people online, is there a reason for Hawaii's level of low participation? So why doesn't Hawaii participate at the same level as some of those other states? I don't know that we've done any studies on it, but I think John's going to answer that question. So John, come on up.
I have to use this because the online stuff, right?
Yeah, and you guys have
This room does not need a microphone,
you need it. This
which would be. Well, one of the main reasons is that the property has to be historic. It has to be designated historic, not just that you think it's historic. And so Hawaii, if you look at the National Register listings, does not, as is Idaho and Alaska and some of these other less populated states, doesn't have nearly as many properties listed. Now, the program is designed to work to get it listed in the process. You don't have to wait until it's actually listed to start a rehab project that uses the credits. But it really would help that if we could get more properties listed in the first place. And through districts is the easiest way to do that. You can grab a whole group of buildings. And so I'm getting a little off track from what my talk is about, but I mean, it doesn't have to be, if I was looking at some really old National Register nominations a few years ago, and like the first ones that were when the program first was created, like Union Station in Washington, DC, these monumental buildings, and their criteria for why they're important. And right now it can be architecture, it can be for history, it can be architecture, engineering, history, and famous association with a famous person. Well, in those early nominations, architecture wasn't a checkbox, because if it wasn't great architecture, they weren't listing it at all. It was only great architecture that was being listed. Now we're listing concrete block warehouses because they represent history in a broader sense. So don't be deluded into thinking that it has to be some grand monument to be eligible for this program. It doesn't. It has to represent something of the community's history, of your state's history, and it can be quite local in terms of its importance, but it's a lot easier to do these things by groups. So let's get started here. As Kirsten did a very good job of telling you why we want to do this and what the things are. One of the things, though, I do want to say right off the bat, and I think John will cover more of this later, that in case like you're a property owner, you think, oh, I'm going to use the tax credits. Well, if I bought a building in my neighborhood and rehabbed it and tried to use those credits against my Park Service salary, I would find it next to impossible, if not very limited, that I could use them. So it's not really designed, because of the law change in 1986, anything that's passive loss, and these credits are considered passive loss, which is why most of the credits are going to people who are, their businesses in the building, or they're investors who are real estate professionals, they're using the credits, or even big corporations will syndicate the credits, but the legal cost for doing those things for small projects precludes small projects from basically transferring the credits. You can't just outright sell them, as is the case with most of the state credits. They're much more easily transferred. And so it's really, you have to look at, if you're thinking about doing a project independently, you really need to talk to your tax advisor, your accountant, to make sure that you can use the credits, because you don't want to go through all the trouble. They're expensive. It's great to do the preservation, but if you can't get the credit, then don't waste the time documenting. So as I started with answering the first question, there are several criteria that you have to be eligible for the program. You have to be a certified historic structure. That means it has to be a building. It can't be a ship or a railroad car or a grain silo. It has to be something that can be occupied, human occupancy. It must be depreciable. That means it's income producing. You can't use these credits on your owner occupied home. So if it's something you can appreciate on your taxes, then that makes it eligible for the credit. And it must be listed in the National Register of Historic Places. It can be part of a district, like your Chinatown district is here in Honolulu, or it can be an individual building, like I think that's a Podmore building, right? It's listed individually. It just takes a lot of documentation to make the case for an individual building, whereas for a district, sometimes you could grab a whole lot at one time. And I don't know, Jessica could probably speak to this. Every state gets a grant to operate their preservation office from the federal government. And a percentage of that money has to go to certified local governments, like communities that have landmark commissions and are set up to manage that. And that money can be used to do surveys and get things listed. So I don't work in that program directly, but if you're not fully utilizing that money to get more properties listed and eligible for the program, then you need to push your bureaucrats to do that and make sure they're using that program fully, because that money, if they don't use it, it goes back to the federal government. So some states are not very good at using that money, but that's a way to get more properties eligible. The second criteria is that the rehabilitation, and this is in the tax code, must be what they call substantial. That means it has to be you have to spend more on the rehabilitation within a 24-month period than your basis in the building. That's what like if you've owned the building for 20 years, you may depreciated it down to nothing, because that's the way that depreciation works. So then your minimum is $5,000. So you could put a new roof on it on some buildings, and that's a preservation project. It doesn't have to be any of the stuff you think of as grand, elegant preservation. It can be a new heating system, as long as it doesn't diminish the integrity. But it's going to be key to what is that value of the building, not the land, just the building, the part that's depreciable. And John may talk more about the substantial rehab test. And qualified expenditures are basically anything you do on the building that's a permanent part of the building, not furnishings, but all of the systems that make it a modern operable building. Advance here. Tried everything.
Yeah.
Oh, yeah. So, all right. And finally, it must be a certified rehabilitation. And that means if we start from the top and look down, the IRS code that created it says that it must be the rehabilitation building as completed must be certified by the Secretary of the Interior as being consistent with the historic character of the property. Well, the Secretary of the Interior has delegated the Park Service, which we are under the Secretary of the Interior, to determine what achieves consistent with the historic character of the property. And to that end, there we go. I'll just use the buttons. The mouse wasn't working. All right. So rehabilitation means returning a property to a state of utility through repair or alteration. It makes possible a contemporary use, and it doesn't have to be a new use. It can be a continued use. It can be the same thing. You don't have to change use. And it preserves, and this is an important idea, portions and features that are significant to the property's historic, architectural, and cultural values. It doesn't mean you have to restore. You can always leave things alone. And I think the next slide will illustrate that. Yes. It can include, like this building at the top, you can see it in the before condition on the left where it looks a little sad. And on the right, they put the tower back. So there are different categories in the preservation world: preservation, rehabilitation, reconstruction, and restoration. And rehabilitation is the broadest of them all. And that's what the standards that we use to evaluate use are written for. And it can include some aspects of all those things. And that building with the shingles is that example. Like there's some parts that have been restored, some have simply been preserved. The tower was reconstructed. It can be the most encompassing idea in the preservation world that's applied to this. But what you don't have to do, you can always leave what you have. However incompatible and inappropriate that bricked-in storefront is on the slide on the right, you could leave that. If that was your building and you were to do a project, as long as everything else you did was respectful of what you had when you started, nobody's going to make you restore that. So that's often a misconception that you have to do restoration for these projects. That's not the case. It does require that we look at both the inside and the outside of the building. We look at the site and environment, the full extent of the historic site to the extent that the current owner owns it. We're not going to hold one owner responsible for what another owner does, unless they've just sold it off to avoid review. That sometimes happens, but generally we're going to look at the entirety of the historic site. In the case of this school, a large athletic field ended up getting a lot of housing put on it, but we were very careful to look at keeping it back from the building enough to make sure that it didn't diminish the integrity of of the school itself, and we felt that the features of the athletic field, though they're important to a school, were not so important that they couldn't be used for the purpose of building more housing. Preservation, rehabilitation can include additions to buildings, like this piece here on the left of this little public building. I think it was courthouse in the upper Midwest. You can add things as long as you do so compatibly and respectfully. And generally, I would say the word that's not in the standards that I wish was there was subordinate. When you're making an addition, it should never upstage the building. That's an underlying concept if it both is compatible and differentiated. And differentiation does not have to hit you over the head. And you can take material away, as in the case of this warehouse building, where part of the floor plates were taken out to create an atrium. So it doesn't mean every stick of material has to be saved. It depends on how you do it and where you do it. Mostly, though, rehabilitation involves repair and replacement of damaged material, and making changes to accommodate a new use, like putting an apartment in this industrial building here on the right, adding things that make the building subject to new use. So there's some general concepts. I'm not going to go through all 10 standards one by one, but they're just general ideas that these standards articulate and reinforce in one way or another. One is that fundamentally, we want to preserve the historic character of the building, how you understand the building when you look at it, when you walk through it. Keep historic features and spaces, mostly those that really characterize the building. Everything is not equal, and we'll talk about that. If you have historic material, don't damage it. Don't sandblast your brick, don't water blast your wood siding. Material that you do need to replace should be replaced to match. Don't alter the specific history of a property. A lot of properties have changed over time, especially when you're in a historic district. You may have a building that was built in 1890, and it had a storefront that was put in 1910, and if the period of significance goes to 1920, then that storefront that's there from 1910 is also important. It's not about always going back to the original. So that's the specific history of your property. You need to look at it in the context of why it's important, the property is important. And then when you do add things, make what you add compatible. So this is just to illustrate don't damage. You can see the pointing work done on here. They cut the mortar and they gouge the brick up and down each way. Or, here's somebody doing a test cleaning patch to find out if the means of what they were using although I think it was a proprietary system with a rotating nozzle to see if it was going to damage this rather soft brownstone. Or on wood siding, how do you strip the paint off of it without damaging it or making it impossible for new paint to stick? Mostly we're going to be talking about repair. If it's possible to repair, one should repair. There are lots of subtleties about that, though, if you get into we don't have time to get into the weeds about that today. And where things are deteriorated enough that justifies replacement, then the application process that Kirsten alluded to, will mention, is designed for you to justify that, to document that, give us pictures so that we can understand why you need to replace. We can be reasonable about this. I spent a decade working as a carpenter. I understand that some things just aren't going to be repairable. You can repair almost anything, but there's a point where it's not reasonable, and we are trying to be reasonable in every respect. But we do say replacement must match. Well, you can see from the original window on the right and the window on the left, the vinyl window, where the grid is between the glass. I think we can all agree that that doesn't match, that wouldn't be an acceptable replacement. When we look at these two windows, it's a little more, they look pretty good. The original window is on the right and the new window is on the left. But it's all about degrees. And in most cases, that's probably going to be okay. But if you look really closely at the two inset pictures and follow the shadow lines, you can see that the new one has a much more complex profile. It doesn't have the simplicity and the cleanness of the lines of the others. So match is a judgment call. There are grades of match, and it depends upon the building, the justification for the replacement in the first place. So don't presume that if you tell your contractor, match this window, and he thinks match is the one on the right, and we're expecting it to be the one on the left, here down here in the bottom corner, and comes in done, and then we're going to have a problem. So everybody's judgment about match is a little different, which is why there's a process for getting these things reviewed and approved. The standards, though, the concepts that I just went through are applied with some overriding principles. Those principles are hierarchy. Every part of a building is not equally important. Some parts do more to contribute to the character of the building. I think we'd be hard pressed in most cases to see anything in the basement of a building that's going to be important to save or preserve in terms of the overall character. And generally, and then cumulative effect. We look at the project overall. You know, sometimes there are things in a project that aren't ideal, but they're a small piece of the overall project. And so if that's all you did wrong, it doesn't mean the project can't be certified. And it also, when we talk about continued use, we really try to be as generous as possible. If a building is a brewery to start with, and they're going to continue to use it as a brewery, like we might let them make a few more changes, because what's more appropriate to do with a brewery than use it as a brewery? But maybe the way they make beer now, the tanks are different, or the heating sources are different. So we try to be as flexible as possible, because standard one is about using a use that it's that's appropriate for the building, and a continued use is almost always the most appropriate. So we don't want to squeeze those out. And this is just some of the wording from the standards where we take these ideas. The standard 2 says features and spaces that characterize property shall be preserved. Well, that word characterize is a fuzzy word. It's a word that we can use to apply our judgment through. It means that if it says that those that characterize the property must not be changed, that's presuming that some of them don't characterize the property. So that's where the wiggle room comes in by looking at these words. Standards 5 and 9 also use the words characterize the property for telling us what we can and can't do. And standard 6 talks about match when you're replacing a distinctive feature. Well, if it's not a distinctive feature, maybe it's not so important that it match. So there is inherent flexibility, but it's not something you want to walk out on a limb without getting some feedback from your state preservation office and from us, Park Service. And this just exemplifies the hierarchy. Here's a little 4-flat building in a Midwest city. Obviously, a lot of it was not done right. This was not a project that was done when this photo was taken. But clearly the front of the building is the most important part in terms of the character of this property. I mean, it has, nice arched windows and a little recess for the entrances. If you look at the picture, you can see that there's not a lot of space between these buildings. And looking down between these buildings, the first windows on the side are halfway down the building. Well, those windows, one would be hard pressed to say they characterize the building, at least from the outside. It's hard to even see them. So maybe there's a little more flexibility in where those are. So there's a hierarchy. It moves from front around the side. In the back, we have these, non-historic porches. Now, it's possible that because of the way the alleys are, the back might even be more important than the side elevation is. Every property is going to be a little different. It's also the case that usually inside a building, the sequence that you move through a building, the stair hall, the entry hall of a house, was probably going to be more important than the second floor bedrooms. In this large hotel in a large city, before rehabilitation here, you can see it had an open mezzanine all the way around. Circled there, you can see the railing. Well, they really restored the space, and the only change they made was they put a glass wall, you can see on the right-hand photograph, behind that metal railing. That's a very important space, but it's a very small change. So in general, the more important the space, or the more important the feature, the less the change. The less important the feature, the more the change. That's just an overriding principle in terms of how you plan these projects to keep them successful and keep them in compliance with the standards. Just as that hotel lobby had very little change, here's a multi-story building, commercial building on the commercial space on the first floor. The upper floors were basically open space for warehousing or whatever they were used for. So the plan of this, as it was rehabilitated, put a lot of partitions in those spaces. They built bathrooms and kitchens and bedrooms. That's secondary space. That amount of change is acceptable. Dividing up the front storefront that much might have been more of a problem. So again, it's the amount of change is relative to the significance of the space you're changing. And then we'll go through this a little more complicated example to just kind of illustrate the idea of cumulative effect. This is a building in Vermont that was renovated very like in the 70s or the 80s with this hideous curtain wall. And you can see the historic photo on the bottom right-hand corner, what it looked like. It had storefronts all the way along the side, and it did not have the slice taken out of it. This was going to be done as affordable housing. and so they got rid of that curtain, that 70s curtain wall piece in the middle, put back, recreated, restored the missing piece. They put back a glazed front all along the bottom, but it's not really, they only have one entrance, and that had lots of entrances before, but it was gone, so they didn't really have to put it back exactly, but they at least captured the fact that it was open, glazed, commercial type space on the ground floor. And on the side, they, let's see. Yeah, so there you can see, it's not the same, but it's more in keeping with the character. This was the backside where it had this one-story, rather poor addition outside the period of significance. They simply took that off. And so they had a lot of flexibility in terms of how they configured the windows here, because we weren't sure what those windows were. So there were a lot of things that they did really well. They restored some things, other things they did less well, but they had some flexibility about the windows. They used aluminum clad windows, not wood windows for this. But overall, it was a good project. There was give and take on all fronts in something like this. And so that's the idea that if we're looking at these things as an overall project. It would have been better, could they have done some things a little bit better, but they didn't. Overall, they met the standards with this project. And finally, talk about, I have some more, we'll talk later a little bit more about some of the details here, but there is an application process for this. So you can, if you have an individually listed building, you can, as long as you take pictures before you have started, you can do a project and never talk to us. But you would be really walking out on a thin limb to do that. You might be you might misunderstand how we're going to judge it and how these standards are interpreted. So the process is designed to have review. In this three-part application, part one, you have to do if your building is not an existing individual listing. If it's part of a district, or if it's a building you want to get listed, then a part one is designed to evaluate that, to make sure it's eligible for listing or make sure that it contributes to a district. There's no charge for that, goes through the state office and comes to our office. Part two is really the meat of the whole process. It's where you tell us what you have now and what you're going to do with it. And nothing is better than the person who's going to do it to know what they're going to do. So it just needs to be written in simple English and explain. Imagine you don't know the building. We don't know the building. All we see are photographs. So you really need to tell us in detail what you're going to do. Thinking about those ideas that I've already talked about what's important and what's not. I don't need to know what your toilets are going to be, but I might need to know if you're going to replace the woodwork in the front parlor. Those are kinds, think about what matters in terms of how much detail you describe. And the things you're going to change are the things you're going to need to know most about. Often it needs to be accompanied with plans if you're moving walls, and at the very least, a plan to show us where you've taken the picture so we can understand where the images are taken from. There is a fee involved with that, and the fee is a sliding fee based on the value of the project. And then finally, when you're all done, you take pictures of the same things you took at the part two, send them to us, and we'll certify the project. You have to do that. You don't have to do that before you take the credit, but you have to do that within 30 months of taking the credit. You have to get that part three in place. And that means at that point, your building does have to be listed within 30 months of finishing the project. There's a lot of wiggle room here. Maybe John can talk a little more about that. And if along the way, plans change, some circumstance, you can't get the window you thought you're going to use, there's an amendment process. There's no charge for that. So, tell us what needs to change and why you're changing. Make sure that you're always in safe ground, that you're not risking this investment you're making and in the end, don't get your credit. We deny a very small percentage of the projects, almost, I'd say more than 3/4, I'm just pulling the number out of the air, but it seems like maybe more, are projects that are done without review. They've done something without checking with us whether it was okay. And then the next thing you know, we have a project that can't be certified. Because what they thought was okay is not what our office, with our years of experience, we have nearly 25 people in the office now between clerical staff and reviewers looking at these projects, and a lot of experience, and the program's been around for a long time. So we're not just pulling these things out of the air. So if we're there to be useful to you, so use us through this process to get help, and use your state office too. Jessica's should be available to talk with you when you have these kind of questions. There are some special circumstances if you have a big project that you're not sure, is it worth investing in the architect to move forward? You can ask for a preliminary determination, particularly if it's a single issue. Like, is it really worth going forward with this? That's something that our website is full of information, probably too much. It'll be daunting, I guess, if you go through it. Try not to get overwhelmed by it and look for the things you need to know. And then you can phase a project. If you need longer than 24 months to meet your basis test, it's possible to do that as well. And then sometimes we have multiple buildings that are one project because they were functionally related historically, whether it's like the housing plantation that we had, or something that's a factory that may have 2 or 3 buildings. We will tend to look at that as one. That can give you more flexibility on any one building in the end. And I think that's the end of it. This is just our website, which if you just Google technical preservation services, you can find this, go to tax credits. There's all sorts of, there are case studies, frequently asked questions from the IRS has posted information on there. But I guarantee if you Google technical preservation services, you will get it. You don't have to remember the web address. It has the regulations, the application process, there's sample applications for different kinds of properties, and lots of guidance about windows and additions and all that sort of thing, what we need to know. So I've probably run over my time here, but yes.
Does rehabilitation, can it include infrastructure to the building, such as new electrical or like AC?
The question is, does rehabilitation include the systems to the building? Yes, it includes everything that's necessary to make the building work. It doesn't include furnishings. It wouldn't include carpeting that's not glued down, but it includes your wiring, your plumbing, the roofing you can't see, your HVAC. The place where it becomes questionable is stuff that's beyond this, on the edge of the building, like a septic system. Those are things that are not well, they're a little fuzzier. Probably you need to go to the IRS or your accountant to ask about that. But everything within the envelope of the building that's part of the structure, that's not something that the tenant's got to take with them when they go, those all are eligible expenses.
Can we add like a sprinkler system?
You have to add a sprinkler. It includes everything that you do. And as I said before, it's not about the stuff that makes the building look like it was original. That's not what we're asking for. We're asking for you to do nothing that diminishes it. Now, if you have a drop ceiling like this in a historic building, and you want to put in another drop ceiling, we need to see, well, what's up there now? Like, is the original ceiling there? You could leave this here, but once you take it out, it's sort of like the idea you break it, you own it at the gift shop. That if you take it out, then you have to see what's historic that you can't necessarily cover it back up again. But we are looking at systems, we're looking at them in order to minimize their impact. An industrial building having a big duct running across the center, probably fine, because it had machinery and storage and all kinds of things. In a fine house, running spiral duct down the middle was probably not fine. We're going to look for ways to try to hide that a little bit better, or put in a soffit, or run it, made a high velocity system or something. It's really dependent upon how you do it, but you get to do whatever you need to do to make your building useful, within the assumption that it's not the wrong use for the building. If somebody has a church, and we have lots of cities full of big churches that are big open spaces, well, there's the basic character of that building is a large open space. You cannot fill it with apartments and think that it doesn't change the character. So there's a situation where the systems and the walls, that would be a problem. But anything that you can do within the framework of what the building is to keep it functioning is an eligible expense. So it's usually not hard to meet the basis test unless you're just doing a paint up, you know, a little repair work. But we have had projects in some of these small communities where property owners have owned the building forever and they've let it run down and do it. You know, they put on a new roof and they have $5,000 and they have a zero basis. So they have a project, and it's easy for me to review that because I don't care if I can't see the roof, what they put on. And they could get credits for it. So don't presume that it has to be some fancy, you know, high-end restoration project with lots of conservators. It can be very ordinary stuff that uses this program. It's really got to be, the hard part is going to be finding a way to use the credits, and we'll hope somebody will help you a little more about that than I can. So I think that's it for me now. We want more question, one more question, we have one time?
Yeah.
Yes,
You know, you strongly suggested we check back with you folks to get feedback along the way.
yes.
What is the turnaround time? How long does it take?
Sure.
You got two questions.
Yeah, I understand. The question is about getting feedback and the time involved in that. The regulations say that the state, if the things should go through the state, in some cases, they don't absolutely have to, but that they have 30 days to look at it. Nobody's sitting on something for 30 days that they don't have to. But, and there's nothing that says you get out of jail free card if you don't get it in 30 days. But that's the goal that we have, is 30 days at the state, 30 days with us. But I answer the phone. If somebody calls up and wants to know a simple question, I'll answer it. You know, I'll try to help them. We should have another 30 days. So if you have something that's, you know, some contractor's waiting, don't fill out a form, give us a call. But if you have something that you really requires some judgment, then you should fill out an amendment. It's all online now. So it takes less time to transmit this stuff, then we should get back to you in 30 days as well. And given the staffing up that has happened in our office, there's less likelihood of things being past the 30-day clock. So potentially as much as 60 days, officially should be less.
All right, next up, we have Jessica Puff, who is going to talk to us about the Hawaii State Historic Tax Credits.
Topic. Be sure I bring up. Hi everyone, I'm Jessica Puff. I'm the Architecture Branch Chief at the State Historic Preservation Division. Like Kirsten said, there is now a Hawaii State Historic Preservation tax credit in addition to the national tax credit. And as Kirsten said, it was created in 2019. The first year for project submittals was 2020, so right at the beginning of COVID. So of course, our program got a lot of applicants in the first year, which we did not. I'm being sarcastic about that. In case it doesn't translate. And so this program has been sort of slow to develop. And now that we're starting to get into a recovery phase, we're trying to get the word out again that this program exists. So our credit, it allows for you to claim 30%, a 30% tax credit on your qualified rehabilitation expenses. So that qualified rehabilitation expenses are any element of your project that contributes to its historic rehabilitation. And kind of playing off of what John was saying, one way to think about it is if you turn your building upside down, anything that doesn't fall out that helps to restore the building can be qualified. So no furniture, nothing loose, things like chandeliers and stuff can potentially be eligible if they are compatible with your historic building. We can talk more about the details about what gets qualified and what doesn't later, but that's sort of the gist of it. As in addition to what John was saying, or similarly to what John was saying, these tax credits are eligible for properties that are considered certified historic structures. And in terms of the state law, that's any property that is listed in the National Register of Historic Places or the State Register of Historic Places. So either. We do have some instances where properties are listed in the National Register, but not the state, and those properties are still eligible for this program. And it's also available to properties that are eligible for listing in either state or national register, either the state or national registers of historic places. But it just has to be listed by the end of the project. Substantial rehabilitation also is required. And this means that your project has to be at least 25% or equal 25% of the value of the building, not the land, which is a huge concern here in Hawaii. The land can be more valuable than the building or the structure that sits upon it. And so essentially what you do is you deduct the value of the house or the building from the property value total, and that's the dollar amount that you want to focus on, just the value of the house. So your rehab or the building, because it can be income producing or not, we'll talk about that in a second. So 25% of the value of the building, if that makes sense. So currently, with the way that the state program exists right now, we have a $1 million cap. So after our office assigns $1 million in tax credits in a taxable year, we're no longer able to assign any other tax credits. We'll have to wait until the next taxable year. So projects are a first come, first serve situation. We have not yet had a year where we've reached that $1 million cap yet, but we do anticipate in the subsequent years, if the program is renewed, that we'll definitely reach that cap. It's easy to do. We've had a few projects that have been submitted as applications in the last few months that would eat our entire budget, just one project. So it's important to know that you get your projects in early in the year rather than at the very end. Like I said a couple seconds ago, unlike the federal program, the state program allows for both income producing and non-income producing properties to capture the credit. This means that it's available to single family residential dwellings. It's eligible or multifamily houses or multi-family residential units like condos or apartment buildings can also capture the credit. So it's not just for income producing properties. In fact, most of the property or the state historic preservation tax credit projects we've assigned are to residential properties or residential projects. And like Kirsten said, the state credit will sunset at the end of 2024. So that means when those individuals who have done projects in 2024 up until that June or July date, they can apply their credits during the 2025 tax credit season, and then that'll be it unless it gets extended. We have asked for an extension of the program, and through that extension, we've asked for a raise in the cap so that it'll be incrementally increased over the next 5 to 10 years up to $3 million a year. So we're slowly trying to build the program so that more credits are available. So with the state credit, project expenditures can be prorated to capture the total substantial rehabilitation portion of the project, meaning that if you have a staged or phased project that covers a number of years, you can capture a moment in time of the substantial rehabilitation expenditures together, so you meet that qualified or that 25% investment. In addition to that, if for any reason the credit that you can claim exceeds what you can claim on your taxes, you can claim it over multiple years, up to 10 years, or until the credit, you've captured the total credit you've earned, if that makes sense. One thing that you should all be aware of, however, is that there is a recapture clause in the state law. So that means that if you make a claim that you've done certain work, but you didn't actually do it, or if you did the work and then you turn around and take it all out, we can come back and ask for the credit back. So please be aware of that. So with the state credit program, it's a 3-step process. So John was talking about like 3 forms that you fill out for National Park Service. The first form being your certification that your building is a historic structure. The second form or second phase is your project scope of work that you're proposing, that we review and agree to. And then the third part is the proof that you did the work. We use the same form that National Park Service created. We do this to keep it very simple and to not confuse people about how to apply to the program, because we have the same requirements. And we review your project against the same standards that the Park Service does. We get to, though, independently for the state program, consider those standards. We don't have to apply them the same way the Park Service will. So we might have a little bit of wiggle room or a difference of opinion on things that we don't have to concede to or allow Park Service to determine the best course of action on. If it's a combined federal and state project, which you can combine the programs and claim both the federal and the state credit at the same time, we will require that you comply with whatever the Park Service says for the federal side of things, but we might be able to give you still some wiggle room on the state credit side, if that makes sense. So that's the first step. That 3-part form is just the first step. The second step, which you all may be aware of, is compliance with Hawaii Revised Statutes, Chapter 60. You will likely submit your project as part of 6010, which is privately owned historic properties, which we will try to do your tax credit part 2 at the same time as 60, but you need to make sure you have that 60 letter in hand, both for us and for whatever county that you're working in, because they're going to need it. That is an independent, separate program that is managed through the counties, and we can't leave the counties out of it. So make sure you comply with 60. And then the third part is that there is one additional tax form that you need to fill out for your state taxes, and that's Form N325. And there is a portion on that form at the very top that we need to certify. We actually put in the dollar amount of what your credit is for that year that you're claiming the credit on. So if you have a credit that you're claiming over multiple years, we might have to give you more than one of these forms, or you may have to come back to us for another one of these forms. And because of this, in addition to having that 3-part National Park Service form, we do ask for one additional item, and that is a list of all of your expenses and receipts. Because, like I said, we have to verify that you actually spent what you said you spent, and our administrator has to sign your form that you file with your taxes, indicating that you actually did what you said you did, and you're eligible for that dollar amount. I think one other thing that is useful for this form for you guys all to talk about, and I don't know if John talked about this, I can't recall, but this is your tax form. Like I said, it's 2 parts. The first part is just all the numbers. The second page of it is who gets assigned what portion of the credit. So if you have multiple property owners that all are invested in the same property, whether it's residential or commercial, you can assign a certain dollar amount or percentage of the credit to each person who owns a stake in that property. And that's what the second page is for. I'm already wrapping up, which might be good for you all. So if you are a huge historic preservation tax credit stand now, particularly when it comes to the state credit, and you want to know a little bit more about it, Mary Kodama, who's sitting in the very back of the room in the green shirt, she is our historic architect, and she is taking over the state and federal tax credit reviews for our office brilliantly. She's a great person to talk to. She wrote a fantastic article for Historic Hawaii Foundation's newsletter in October, which is on their website. If you go into the PDF though of this presentation, the website link I think should be linked to this page of the presentation, so you can click on it as well. But it gives you just a little bit more information about the program. But yeah, I think that is, oh, one last thing, and I'm glad I got my notes now, is, and I think this kind of goes into the question I think posed at the very beginning about why we don't have more applications here in the state of Hawaii. I think part of it is that there's just not enough knowledge about it. I think our office has had to, or has tried to do trainings or share public information about it, but it hasn't gotten a lot of traction. I know internally in our office, there's a lot of confusion between the state property, or not the state, but the property tax reductions that different counties have. Some people think that they're one and the same program and they're not. So just for those of you who aren't aware, most of our counties have some variation of a property tax reduction for listed historic properties. Some for just residential, some for just commercial. Like I said, it varies from county to county. It's all established by the county. Our office sometimes plays a role. Some, like City and County of Honolulu has a form we have to fill out for them. And I think people think that that's what the tax credit program is, and it's not. It's this program established for investing in rehabilitating historic buildings. And so I think that kind of plays into it as well. But I think one important takeaway, though, is that there's two programs, one for rehabilitating buildings, and your county likely does have a property tax reduction program that property owners can also collect on. So that's it for me. That's your question.
Can I take a minute to just state? After Jessica went over this, I thought I was trying to make some notes about things that are the same and different between our two programs. And it sounds to me like, from what Jessica said, that a nonprofit couldn't choose your program any more than ours, because they're not, I mean, even if they're the owner, they're not paying any taxes, and your tax credits are not transferable, correct?
No.
Right, and neither, well, ours is the same. You can't, a nonprofit only can use the credits if they can bring in an investor who's going to have an at-state risk in the project. The other thing I think is noticed important is that the threshold for the state credits is much lower. It only has to be 25% of the value, whereas ours, it has to be equal to the basis of the building. So that makes it a lot easier to use those. Ours, however, gives you a longer window to actually get the building listed once you're done. According to what Jessica said, hers, you have to, with the state credit, it has to actually be listed at the time the project is finished. Ours, it's an IRS rule that you can have 30 months to get it done. And finally, then the other thing I think is interesting is that for the state credit, and that's typical of most states, the credit, you have to provide documentation. There's almost like an audit that you submit all your receipts or your expenditures. The federal credit works like every other part of the tax code. It's an honor system. It allows you to cheat liberally. It's what you tell them, and if you get caught or you don't get caught. But it's something where you put down on form 3468 how much credit you're taking, and nobody's looking at that until they ask for it. But you better be ready to provide it if they ask for it, because there are people who get audited with this stuff. But you do not have to be listing these receipts at the point when you take the credit. But it's very typical that for state credits that you do. Did I miss anything else that's sort of a difference between the two of us? I thought that was kind of worth pointing out.
I think that's what I can think of right now, yeah.
Okay, well, thanks for the time.
I have
Yes.
a fundamental question. I'm sorry for being like, I hate the country.
No, but
And I have a really fundamental question.
Sure.
Property owner, with 2 historic buildings, not certified historic, but 55 and 60 years old, and I'm all about culturally and personally the preservation. Is it a misnomer to believe that I need to have a certification of these properties before I'm eligible for any tax credit, be it on the federal level or the state level?
At the federal level, it would have to be listed in the National Register of Historic Places.
Through the state.
Through the state process, the state review board, but it comes ultimately to the Park Service. It could be, maybe if the 2 buildings are related, it might be easier to list them as a group, like on a farm complex or something. But it has to be listed within 30 months of you finishing the project. But we can tell you up front whether it's eligible to be listed, so that you can be working on doing that while you're working on your project. You have something?
Oh, the state is basically the same. The part 1, I think that John sort of was trying to go over that you might have missed, is a form in the 3-part federal form series that you submit to us. It's the first step that you do, that allows us to verify if it's either listed already or if it's eligible for listing. And so you submit that form with kind of a description of your property. We might ask for photos, we might ask for more information, but we certify in that first step that your property is actually eligible. One point that may be important for you, though, I heard you say there are residential properties. If they're not income producing residential properties, meaning that if you're not making, you don't have a tenancy or something like that on it, if you live in the residence, it's not eligible for the federal credit. It is eligible for the state. Okay, yeah, so your property, if you live in it, it's eligible for only the state, but if you have an income producing property, you can likely capture both.
Starting point is
It's up.
what state first.
Yeah, submitting the property, the project or your part one to us, yeah.
Thank you.
I do think it's worth reinforcing though, that it's not just because it's old. You have, and the register is designed to make something, to describe importance in a context. Like how, like, is it the best one of its type in the area? Is it the oldest of its type? Is it the best, what is the context? And it could be about its history as well as its architecture, or somebody who's an important person is associated with it. But you can't just, we get a lot of things like, well, my building is so old that like it has to be historic. Well, you have to kind of frame it in some context.
Yeah, thank you.
All right, thank you both. Jessica mentioned that there are also local government level tax incentives for property taxes, and we have information on that at historichawaii.org, both about, actually for all of these programs, federal tax credit, the state tax credit, and all the county tax, property tax reductions. So there's additional information that we will send out afterwards with all of this. Do you want to take a break now, or do you want to hear the case study and then take a break? I'm hearing they want a break. Okay, wait. I saw two questions and then we'll take a break. So question one here.
Okay, from the time you apply to get registered on the state and the federal, what is the ballpark turnaround time?
Okay, so the question is, from the time you submit a nomination for listing a property on the state and or National Register of Historic Places, how long does it take? I'm gonna ballpark this and say the Hawaii Historic Places Review Board meets quarterly. And from the time they set their meeting, you have to back out from that to all the public notice period, which is, I believe, 60 days. For 45 days for Oahu, I think it's 60 days for the other islands.
Right.
And so before that, of course, the State Historic Preservation Division has to review and certify that your application is complete, that you included all the pieces to it. So once you think you're done, you submit it, they review it, it gets noticed, they have the meeting is approximately 90 days. At the meeting, they held a public hearing, they take testimony, they review it, they make findings. If they act at that meeting, then I think they have a couple of weeks to give you the paperwork saying, yeah, you're done. If they defer it or ask for more information or continue it to the next meeting, that'll add time. So Jessica, come on up.
The only thing that I want to clarify or just reiterate is that you can be in the process of listing your property in the Hawaii and National Registers at the same time that you're scoping out your part two or your project, your rehabilitation project. So you can be doing your part one part of the form and your part two part of the form, I guess I'll put it that way, at the same time. You don't have to wait for it to get listed first before you actually develop your scope of work.
But you have to be pretty sure that it will be listed, right? Because I've seen properties. So you have to be, because you're going through the process and then it's not listed, it won't be eligible. Right?
Yeah, you'll want to, and that can be, that can be held, that kind of can be preliminarily determined, or we can give you a sense of it right off the bat within a conversation or something like that. It could be an email exchange back and forth a little bit.
And if it's a federal part one, it comes to the Park Service, the people at my level at the National Register will look at it and say either it is or isn't eligible. Now, it may mean you have to go back 3 times to make your case, but once they've said it's eligible, there's no backtracking about that unless you destroy its integrity. So if you're doing the federal app and you send a part one in to us and the National Register review is there to decide it is eligible, then you're pretty safe. You may just have a long haul with your state review board, but you're not gonna lose out in the end.
So it's two separate process, state and federal, and they're independent of each other?
No, they're not. Not for the only thing that's independent is if the state wants to, if you want only a state credit and only need a state listing.
Yeah.
Then that can be independent, but if you're doing the federal too, then the state is sort of part of that process. And the review board process at the state level is part of the federal process.
Yeah, and so when your nomination goes before when you go to list your property in the state and national register, our review board will look at that nomination that you submit for both the state register and the national register at the same time. You don't have to go to the review board twice. You don't have to submit your tax credit forms twice. You just do both processes one time and indicate to us, I'm interested in, yes, both the state and the federal credit. And that's how it'll be reviewed and how it'll be submitted to Park Service.
The one timing thing that's gonna matter is that for the state credits, I understood what Jessica said, you have to actually have it listed by the time you finish your project. It has to get through the state review board and they have to say, okay, by the time the last nail is hammered in. For the federal program, you don't. You can have a little longer to get it through the review board. As a matter of fact, like 2.5 years longer to get it through the review board after you've gotten our approval for the work. So there's a little more wiggle room in time if you have a nomination that's difficult to make the case for. But you really don't want to risk losing your state credit, which is quite valuable. So you really need to, maybe just slow down the work a little if you're having trouble getting it through the review.
Or you just wait to get your part 3. If you're going, this is just for if you're going for the state credit, we can hold off like evaluating your part 3 for state certification and just do the part 3 for federal certification until your property gets listed, which we're getting to the weeds a little bit on the technicalities of administrating state law. So if you're in that situation, just talk to us and we can tell you what the path forward is, because there is a path forward for it.
Yeah, I think that's the important thing is for these questions, have a conversation. Don't just sort of assume you know the answer. Have a conversation first. John, did you have an answer to that question or another question? Okay, you have to wait.
Sorry, this is a question on the state credit. So if you don't meet your $1 million cap in a given year, does the balance roll over so that you can build up a little pot?
All right, so the question is, for the $1 million cap a year for the Hawaii state credit, does that cap accrue over time? If it's not used, does it get added to the next year, or is it $1 million a year to use it or lose it?
So use it or lose it. Yeah.
All right, John.
For the state historic credits, can you apply for this credit on a project that was completed in a prior year?
For the state historic credit, can you apply for the credit after the fact? The project was already finished. Can you go back and recapture it later?
If it's completed, this is where we interpret it. So if it was completed in a year that you have not yet applied for your taxes for. So if it was completed this year, but you completed the work before you applied for the credit, we can review it and assign a credit. But we can't do it after the fact, from my understanding. So if you completed the project in 2022 and already filed your 22 tax credits, we can't do that. That's my understanding.
Okay, one more question. Okay.
So just to be clear, so the completion of the work determines the fiscal year of the tax credit? Or is it as we go along, we can bill tax credit and do like partial now, partial later?
Okay, so the question is the timing. Is it all in the same fiscal year, or can you phase it and do some portion per year?
And is it determined by the end of the project? Like what determines like the invoice date versus the end of the project date?
So in terms of the state credit, you can phase your project over multiple years to build it up. So if you're going to do it in stages, we would just ask that you communicate to us at the very beginning that for budgeting reasons or for whatever reason that you're doing it, you're going to do it over multiple years. And that at the very end, you are going to reach your your substantial rehabilitation, I'm trying to think of the correct terminology, that's kind of it. Your investment, your substantial investment in the rehabilitation of your property. So you can do it over multiple years, we just need a heads up about it, and that all the expenses that have been accrued that qualify as qualified rehabilitation expenses are accumulated together when you apply for that tax credit.
Can't take interim credits.
Yeah, you can't take interim credits in between, yeah.
So even if the expenses are made in a prior year, you still add them all together and claim them in the same year.
Yeah.
Got it. Okay, we're gonna take a 10-minute break, so we'll come back at 10:30 for those of you who are on Zoom. And then we will have our case study for a project that was done in Kaka'ako. Okay? We know this information has been a lot, and it's sort of drinking from a fire hose in some ways, and it's, you know, both historic preservation, which can be complicated, and taxes, which can be super complicated, and you put them both together and they're really complicated, and then you add federal and state programs, and it gets even more complicated. So we appreciate you kind of staying with us through some of this. I'll mention again, we are recording this, and the slides will also be available with the recording at historichawaii.org afterwards. It'll take us a couple of days, but we will get that up. And we'll be sending out an email to all of our participants with links. And those links will also include links to other resources, including some of the pages and references that have been mentioned as we go. But because everything up to now has been sort of in theory, we wanted to make this more specific by sharing some examples. So our first example is a project that's in Kaka'ako on the island of Oahu. And I'm going to turn it over now to Shelby Mendez.
Hi, my name is Shelby Mendez. I work at FAI Architects, and FAI Architects were the historic consultants for this project. The Dearborn Chemical Company building is located on Ward Avenue between Waimanu Street and Kawaii Hollow Street in Honolulu, and you might recognize it as it's the location of Patagonia's new Honolulu flagship store. Built in 1928, the building has supported several businesses over the years, and until recently seemed to be an understated building in the shadows of nearby Kaka'ako redevelopment. Now, due to the building's revitalization, the Dearborn Chemical Company building is one that shines like a gem of old Kaka'ako. The Dearborn building is a great example where historic preservation was the primary motivation within the rehabilitation project. And I would like to note that DKKY Architecture Studio was the project architect, and FAI Architects prepared the historic register nomination and tax credit application as the historic consultant. Here are some aerial photographs for visual context of the building's location. From these, we can see that the Dearborn building has remained in the same location over the decades since its construction. And we can also see how much the community fabric or context has changed from residential and light industrial warehouses grouped on either side of Ward Avenue to the industrial and high-rises Kaka'ako has become known for. And it was concerning to some that the history of Kaka'ako, which was evident in its buildings or lack thereof, was becoming lost by the vast amount of the redevelopment. And the question of would present and future generations be able to recall that Kaka'ako was once known for its salt pans and rice fields and its spirited multi-ethnic community, or it's as an area of entrepreneurship. And that was a really large reason that moved the property owners of the Dearborn building towards historic preservation. The building was constructed in 1928 as a one-story water treatment facility and warehouse for the Honolulu branch of the Dearborn Chemical Company. At the time of its construction, the Dearborn building was one of a handful of non-residential buildings, one of only 3 masonry buildings, and the most substantial building in its area at the time. The Dearborn building was then renovated in 1965 to fit 2 stories of individual retailers and offices in the same amount of space, plus a front addition. After the renovation, the building became known as the Universal Building. And this photo is of the building after its 1965 renovation. Here we can see that the one story front addition and store parking lot, and the infill bay is above the addition's flat roof. And in this photograph, we can see that the tall window on the Waimanu Street elevation is infilled with glass blocks, which was a typical material of the 60s and 70s. And from the exterior, we can see that certain aspects of the building's character-defining features were maintained and were still recognizable, such as its massing or form, the gabled parapets on the end, the slightly projected columns between each bay, and the sheet metal roof without overhanging eaves. However, we know that the renovation altered the inside of the building as well. So the current owner obtained this property with the full intention of helping the building stay relevant in Kaka'ako. The basis of the project was to have the building undergo a certified rehabilitation so that it could be reused and to additionally benefit from the federal historic tax credits. The project followed the Secretary of the Interior's standards for rehabilitation, which meant that while repairs in certain areas of reconstruction were undertaken, the project retained the historic character of the building in keeping with the design, scale, color, texture, and other visual qualities of the building's original design. The project rehabilitated the building according to its determined period of significance, and in this case, back to its original construction date. The building's remaining original features were repaired where they could be and replaced and reconstructed if necessary. And additionally, the rear windows, which had been covered by metal siding, were uncovered and repaired, as you can see here. The rehabilitation work also included removing alterations which were not original to the Dearborn building. So this included that storefront addition on that projected from the facade. And by removing that front addition, more space could be later used for vehicular and bicycle parking. On the interior, majority of the second floor was removed since it was not evocative of the warehouse's past. And more importantly, it didn't appear in that 1928 floor plan. But for functional reasons for the present and the future, only two small areas of the historic mezzanine were kept in the rehab to harken back to the original design. The project then reconstructed the entire facade, but for safety, the new facade was constructed of reinforced concrete with a board form pattern on the inside so that visually it appeared similar to the original construction method. However, and then energy efficient windows that were visually similar to the originals were put in. The 1965 renovation also reoriented the entryway to the Ward Avenue facade. So the rehab work decided to keep that front entry on Ward Avenue to support the building's new use. And the project returned both the exterior and interior back to its 1928 warehouse character. And the product was an empty shell for tenants to operate within. The abundance of windows, daylighting, and the large open volume created an ideal flex space ready for a variety of uses. To maintain the historic industrial character of the building, the owner's lease agreement prohibits tenants from permanently altering it. The owner was open to leasing to any tenant as long as they were willing to adhere to their requirements. But these factors also made the Dearborn building really ideal for retail space, and it attracted the like-minded retailer Patagonia to move in as the first tenant after the building's rehabilitation. So this project began in 2018 before the state tax credits took effect. So the current owner of the Dearborn building opted to participate in the federal tax credit program and were able to qualify for that 20% tax credit, which meant that 20% of the tax, or the 20% of the qualified rehabilitation expenses would be credited back over the 5 years post-project completion. And additionally, the property qualified for the credit since it was going to be used for income-producing purposes like leasing to tenants, and it was a certified historic structure. The owner fully funded the substantial rehab work with no other partnerships, and they chose to use the federal historic tax credit to kind of reclaim their upfront expenditures. One of the larger expenses came from ordering the 11 bays of new steel windows to complete that reconstructed front facade. And the tax credits only applied to qualified rehabilitation expenses, which included the cost of the building's structural components, such as its the repair of the steel trusses, refurbishment and repair of the remaining historic windows, repair and repainting of the exterior walls, and re-roofing to meet the code requirements. But also the tax credits could have covered like the design fees. However, the tax credits were not able to reclaim funds associated with demolition and removal as needed for the non-original one-story addition, the interior partition walls, and portions of that second floor mezzanine. Parking lots, paving, sidewalks, and landscaping are not covered either. These repairs were consistent with the SOI standards for rehabilitation and retained the historic character-defining features of the original warehouse building. The owner paid the extra expense to expedite certain processes in order to qualify and apply for the historic tax credit sooner than later. One of the big challenges was actually inherited from the decisions made by the immediately preceding owner, whose goal was to keep the 1965 front addition and also make additional renovations to the building. But their design decisions could have potentially prevented the Dearborn building from being eligible for the federal tax credits. They began removing historic elements of the building, and for whatever reason decided not to finish it, and instead they transferred the deed to the current owner, who was really quick to step in and get the building before anybody else could buy it and demolish it for another high rise. And at the beginning of the tax application process, the Dearborn building was actually not listed in the National Register of Historic Places, and they needed the Hawaii Historic Places Review Board to list it on the Historic Register. But due to the 1965 alterations and the previous owner's renovation decisions, some members of the review board opined that not enough aspects of the historic building were retained, and it couldn't be eligible potentially for those for the listing and for the credits. So the current owner really put up a strong case for the board to review the building for its pre-renovated state, and stressed their commitment to rehabbing the building to its historic 1928 character in order for the review board to vote in favor of the building. And also because the building is in Kaka'ako, the HCDA required 4 public hearings for the building. The only issue there though was it didn't have enough landscaping, so then they added more landscaping on the corner of Waimanu and Ward to just address those. So the owner fully achieved their goal of preserving a piece of old Kaka'ako. The rehabilitation revitalized the Dearborn building and helped it stay a relevant part of the community. With the help of the current tenant Patagonia, the building is a venue for a community to gather and learn more about the history of the area, the building, and historic preservation in general. And along the way, the owner also opted in to create a historic preservation easement for the property, which has a one-time tax deduction. And the preservation easement is kind of very complex. But in simple terms, it protects the property in perpetuity as determined by the property owner and the easement holder. The first advice for owners is to understand the factors and requirements of the federal tax credit program and what's really required to be eligible. So consider if rehabilitation will work for you personally, and if it does, that's great. But a lesson from the Dearborn project is to not do any work to the building that could jeopardize its eligibility for listing on the register, and therefore its eligibility for those tax credits. Secondly, consider, like Jeff and John said, early meetings with the SHPO and TPS department and NPS, so you can really gain that provisional clearance for your proposed rehab work. And that's highly suggested, right, if you want to be sure that your proposed work will conform to the SOI standards of rehabilitation in order to make sure that you will be eligible for the credits. Thirdly, the historic tax credits can lead to a large financial savings in the end, but owners have to spend money to save money. And the owner of the Dearborn building was actually keen to malama and do the right thing and was willing to pay the expenses that came with the rehabilitation. In their case, their tax credits were a welcomed incentive, but not their main thing that motivated them. And so the historic tax credits are kind of an added benefit if you're already planning on doing a hefty renovation or hefty rehabilitation anyway. But there are ways to traverse a more affordable path of rehabilitation. And lastly, it will take a bit of time after the rehabilitation is complete before reaping the tax credits and gaining your money back. But if you already own a historic building and have the drive to rehabilitate it, consider pursuing the historic tax credit. The perfect candidate for a project like this has the time and is willing to put in the effort. The Dearborn building is a great example of a certified rehabilitation project in Honolulu. And it's really apparent that there's something special about it, even from before the moment you walk inside. The rehab has sparked a renewed interest in the building and its area. And as the building's tenant, Patagonia staff have become really quite knowledgeable on the subject as well. So I highly encourage you to hop in if you're in the area. Yeah.
Thank you, Shelby. This really is a lovely project, and we wanted to highlight it because even though it was kind of a combination of restoration and rehabilitation, it really does show that you can see beyond kind of deteriorated and not very well maintained property to what it could be, and how these kinds of programs can help make that happen. So it's pretty exciting. We're going to keep going and hold questions until we get to our Q&A, and I'm not forgetting questions we're getting online. We'll just make sure that we address some of those when we get to that too. But we did want to take some time to talk about a little more complicated, or so far this has not been complicated. So far this is straightforward. We're going to add some complications here, which is syndicating historic credits and combining them with other kinds of low-income affordable housing tax credits. So John Lee is going to take us through some of this.
Thank you, Kirsten. Hi, everyone. My name is John Lee. I'm with Capital Partners, and we're a syndication company that syndicates federal and state low-income housing tax credits and also historic tax credits. Well, and so another useful way to utilize historic tax credits is to combine it with the low-income housing tax credits and create affordable rental housing. So low-income housing tax credits, in short, we like to call it LIHTC, is a federal tax credit program that subsidizes a portion of the cost to build rental housing for low-income families and individuals. And you guys kind of heard the QREs kind of being tossed around. So again, these are the costs that are eligible to calculate federal historic credits. And so what's nice about it is that a lot of the QREs are also eligible to claim low-income housing tax credits. So combining these two programs, you could really maximize, the amount of tax credit you can get for every dollar you spend. Okay, so let's talk about LIHTCs for a second. There's two types of credits, a 9% and a 4%. I'm not going to go through all the details of each one, but just wanted you guys to know that there are two types of credits. And the 9 and 4, those are just the percentages you use to calculate how many credits a project can generate. So that's at the federal. At the state side, Hawaii also has a state Hawaii low-income housing tax program as well. And the credit amount is equal to 50% of whatever federal credits a project is allocated. Here's a chart of some characteristics of the different tax credit programs. So HTCs, or historic tax credits, Those are delivered evenly over 5 years. How it's calculated is 20% of the QREs. And those are the qualifications, and as John and Jessica mentioned, the capture period is 5 years. With the LIHTCs, those are delivered over 10 years. And it's calculated based off of the 4% and 9% percentages. And then the qualifications is that the must meet rent and income limit restrictions. And then the recapture period or compliance period is over a 15-year period. So it's 3 times longer than the historics. And then now moving on to the Hawaii State LIHTCs. So those are delivered over a 5-year period, and they equal to half of your federal. And they still have to meet the rent and income limit restrictions, and the recapture period is also 15 years. It kind of mirrors the federal. So syndicating credits. When we talk about syndication, we really have to understand who can utilize these credits. And so for the federal historics and LIHTCs, those are allocated credits. And in order to get the credits, you have to be an owner of the project. And these credits are allocated based off the ownership percentages. So that's important. So if you do plan on doing, a historic rehab and or LIHTC, and you want to sell your credits, you actually have to bring in that investor into the partnership, and they have to own whatever percentage of the credits you want to sell to them. One thing to note is that for individuals that want to claim these credits, that you are subject to the passive activity loss and credit limitations, which is a cap of up to like 25,000 losses. Unless you are a taxpayer that files as a real estate professional, then you're not subject to those limitations. So this is important because when we do these tax credits, we're really talking about millions of dollars of tax credits. And so you kind of have to think, well, who could really utilize these credits, especially, federal historic is over a 5-year period, LIHTCs is over a 10-year period. So someone, so you're working with investors that have this kind of level of tax planning, over the next 5 to 10 years. So a lot of times we work with we sell these credits to large corporations, such as banks or insurance companies. On the state level, there is a little bit more flexibility. So the Hawaii LIHTCs, these are still allocated credits. So you still have to be an owner, but we put it in, the code is designed where you could specially allocate to any owner disproportionate to the ownership percentages. So an investor who just wants to buy Hawaii state credits can just be, let's say, a 0.01% owner of the project, but get allocated 100% of the state credits. So here's kind of a general tax credit flow chart. Up top, we start with the project partnership. And then let's go from right to left. We have our federal limited partner, and that should have said 99.98%. And so in this example, this developer builder is selling 99.98% of the federal tax credits. So we would create a federal limited partner to be allocated that percentage amount. And in that federal limited partner entity, we'll generally have us as the general partner, and then we'll have the federal credit investors come in through that entity. And then what's nice about the state Hawaii LIHTCs is that you could actually bifurcate it out. So we generally would sell it to a separate investor, or at times we would, and then we'll have a state limited partner. And then kind of the same thing, but they'll only note that they only own 0.01%, but they're still allocated 100% of those credits. And we as a syndicator will be the GP of that entity, and then that's an entity where we could bring in the state credit investors. One differential thing to note is that the state credits or the state LIHTCs are not subject to the passive loss and credit limitations. So individuals can use the credits, trusts, estates, and also corporations as well. Then moving on to the far left, we have our general partner who kind of owns the difference of, to make up the 100%, and they'll also get 0.01% of federal credits, and that's usually the entity that the developer owns. So here's an example of how the credits are calculated. So let's start off with $1 million of costs that are also, or $1 million of QREs. And with that, you'll get 200,000 of historic tax credits. And then with that same $1 million, we can now bring that down to the LIHTCs. One of the rules is that you can't double dip, so you have to reduce your LIHTC eligible basis by the amount of historic credits claimed. So then it drops down to 800,000. Hawaii is labeled a kind of a difficult to develop area or high cost area. So under our tax LIHTC rule, you could get 130% boost. So from that 800,000, you get that 130% boost, and then you multiply it by the 9 and 4% credit types, and then that will generate, that $1 million will generate 936,000 of total LIHTCs under the 9% program, and then 416,000 on the 4% program. And then your Hawaii LIHTCs, same $1 million, you'll get half of that amount. And then so your total tax credits is generated off of that $1 million of QREs, you'll get a total of 1.6 million of tax credits on with the 9% program, and then 824,000 on the 4% program. So now let's kind of move down to pricing, and this gets a little touchy and subjective, but kind of the pricing range we've been seeing is 80 to 85 cents on the federal historic and LIHTCs, and then 50 to 55 cents on the Hawaii LIHTCs. So kind of using that range, for every dollar of qualified cost, that'll generate about $1.14 to $1.22 in equity on a 9% transaction, and then 60 cents to 64 cents on a 4% transaction. So it kind of shows, this is how you could best maximize the credits, kind of combining it with historics, LIHTCs, and if that state has a state program, you could throw that in there as well. Hopefully it'll generate more equity, help offset some of that development costs. So key points, John and Jessica went over this. In order to claim the historic credits, you need to get part 1, 2, and 3 completed. When you're combining with LIHTCs, one thing to note is that our investors, they want to see the part 2 approved prior to closing. So sometimes that could kind of, delay or set the timing when that deal closes. Another thing to point out is that the LIHTC has a compliance period of 15 years. When you're kind of starting a LIHTC deal, in order to be competitive to apply to actually win these credits, you actually have to elect to extend the affordability period of a project to up to 60 years. So a lot of our developers in Hawaii who apply for this LIHTC program, they're electing to keep this project affordable for 60 years. So that's something important to note. If you're planning on doing this, for historics and LIHTCs, know that this project is going to have to stay affordable housing, for 60 years. When we do deals with historic credits, there are some underwriting considerations and guidelines that we have. So we like to see a 15% hard cost contingency. Rehab deals are tricky. There's a lot of unknowns. Once you start going through the rehab process, bringing down drywall, whatnot, seeing piping and all that, there are times where there are scope of work that wasn't determined prior to close. So that's why we kind of set a higher contingency amount. Utility costs. So it's harder because we're underwriting the operating expenses, over the next 15 to 60 years. We want to make sure that we're building affordable rental housing and it's feasible for long term. So then we have to kind of project out what are the costs of the building, annually. And with utilities on historic rehab deals, sometimes it gets a little trickier. And it's harder to estimate because you're kind of working, because you're working with a building envelope where the original, it wasn't designed for multifamily. You know, so maybe this building has taller ceilings and, you know, so your utilities are generally going to cost more. And I want to kind of jump down to energy efficient. You know, just from our experience, historic buildings just tend to be less efficient, you know, especially if you're kind of keeping the same windows, maybe it's not as well insulated. And so there's just less green options are available when we're doing a historic deal with the LIHTC. Now, unit configurations. You know, a lot of our developers like to maximize the units in the space, and it can be challenging. So you could just imagine, they'll have a lot of units with varying sizes. And when you're trying to, or at least when we're trying to underwrite, well, how much rent would that unit generate, or what's the maximum or achievable? It gets a little tricky because it's not as comparable to the market. Hawaii is probably different. There's a huge demand in affordable housing, so I'm sure, you know, the rents would be achievable. But we, you know, for example, we've done a deal in Wisconsin. It was a historic rehab and it had windowless bedrooms. And it's just hard to, you know, when we're comparing the market, because by code, all bedrooms need to have windows, but because this is a historic rehab, it kind of got grandfathered in. And so that was kind of a challenging of, should we discount that rent or not when we're underwriting it over the next 15 years. The impacts with schedule delays. So when we're selling credits to investors, and I kind of mentioned the different credit delivery periods, these investors are expecting these credits in those given years. So if you're assuming a project is going to be completed at, you know, end of 2023, and you're going to deliver credits starting 2024, they're kind of open on that, and their investment is based off of that expectations. So if your project ends up being delayed, you're now delaying the delivery of the tax credits, and our investors, you know, will structure a limited partnership agreement. They'll say, well, you have to make me whole, my return whole. So what they do is they reduce the amount of equity that they're paying for these credits. So we call those adjusters. So instead of that 80 to 85 cents, maybe it's, you know, down to 80 cents or whatnot, or whatever credits that you're not delivering at that given time. And so, you know, that's typical. But when you combine it with LIHTC historics and state LIHTCs and maybe even state historics, now you're a month delay is now impacting all those credits and all those deliveries. So it could be a large hit when things are delayed. So that's something that from an underwriting perspective, that's what we look at to make sure if the project's still feasible, if it were to be delayed a few months or one. And then I talked about energy efficient and then replacement reserve. You know, generally replacement costs on historic builds just cost more. So we'll like to see maybe a higher replacement reserve on an annual basis for a deal with historic credits. I kind of went through that quickly because I feel like there might be some questions, so wanted to save some time for that.
Are you a venture capitalist overall?
We would say, the question is, are we a venture capitalist? I would say, no, I would say we're more of a real estate kind of investor, because we have to really understand when we're doing low-income housing tax credits, we actually have to understand the real estate that we're investing in. Part of us being a syndication company is we're doing a lot of the underwritings for the investor. And then we're also asset managing it, you know, throughout the compliance period. So we really have to understand real estate.
These deals are viable, they have to go through all this, there's kind of nuts and bolts. Yeah, threshold.
Yeah.
The profitability comes by.
So the question is, are these deals viable? I would say yes. There's a lot of different players in this. You know, we got the developers, we got the syndicators, we got the investors. And we, as a at least for the syndicator perspective, we try to make it viable for all parties. Because we don't want to go into a business or a deal with someone where, there's no incentive for them. Especially when you're doing a real estate transaction, we want to make sure that the developer is incentivized so that they could, build the building. And then also incentivized through 15 years, at least, I say 15 years because that's how long we're generally in the partnership. So that they could kind of keep it running and, making sure that, you're paying the debt service and you're kind of protecting the tax credits because there is that recapture period. So you have to have the units stay qualified with low income families and individuals. So we gotta make sure that there is enough incentives to keep everybody on this.
What's the least size project that you syndicate?
Dollar size, so one, we don't syndicate just historic tax credits. There are other companies that do that. We're more on the multifamily, so we want to see it combined with the low income housing tax credits. So lowest size, we probably deal with 5 million, probably.
Credits or
of tax credits. And that's not worth our while, just because for me to model this out, for our lawyers to review documents, it takes the same amount of time to do a $5 million deal and an 80 million. So, we like to scale, but we also understand the importance of doing these size deals. But I just feel like over the last 4 years with cost inflation, debt rates rising, all these projects have just gone into be like in the 10 million plus size, just out of the inflations.
Where are you located?
I'm located in Los Angeles.
You do your deals nationwide.
We do deals nationwide. We do have a large portfolio in Hawaii. But yeah, we are wherever there's tax credits, we're there. We have even in the US territories.
One more question. What are you seeing as far as pricing of the state historic?
Price on state historic. That's good. I think Mark was going to talk about that a little bit. It's tough because when you kind of combine it with all the different credit types, the obstacle we ran into was how do we allocate those state credits? So the investors that we sold the credits to weren't able to utilize the state historic credits because it was a Hawaiian-based bank, and we read the code, and they weren't able to offset franchise taxes, so they couldn't use the state historic tax credits. And then so we kind of went through the kind of the brain damage of figuring out, well, how do we separate it out and who else can we sell it to? And our tax councils kind of got hung up on certain codes where we couldn't specially allocate the state historics away from the federal historic credits. So then we haven't been able to sell the state, to answer your question, we haven't been able to sell the state historic credits yet. But I would say because it's an allocated credit, it would probably, but it's delivered over 1 year, I would say maybe 55 to 65 cent range. So the reason for that, and I'm kind of more talking about it, selling it to corporate investors. We haven't done a lot with individual sales. So for a corporation, and kind of what Kirsten kind of brought up at the beginning of how those tax credits are recognized, you reduce your state tax expense by the amount of state credits. So for a corporation to say, okay, great, I reduced my state expenses by that. Well, now I'm actually paying, I have less tax deductions on my federal side. So you lose out on some benefits there. So for corporations, their tax rates are 21%. So then when we sell these state credits to invest to corporations, we say that they assume that for every dollar of state credits is actually worth 79 cents. And it's because they lose out on that federal tax deductions. So then you could just imagine if it's only something's worth 79 cents, at what time are you buying it? When are you claiming these credits? How much is that worth to you? So, and it's also the state historic program in Hawaii is capped at $1 million. So then it's scale, is that what kind of benefit or discount do I really need in order for us to kind of make this investment? Thank you.
Sorry, I'm trying to keep us on time and leave time for questions at the end as well. So not to cut off this conversation, but I do think it will be helpful to have a case study. So one reason, so John Lee is with Hunt, which is a private syndicator. There are others. So I told him he couldn't do an infomercial. And so there are other syndicators who do this kind of work. The National Trust for Historic Preservation has a independent subsidiary that also works on these syndication of credits, basically an investment in historic credits. So they're another option, and then many of the banks will also be investors. So you can certainly talk to John, and I'm not saying don't talk to John. I'm just saying that we didn't want this to be, oh, you have to use them. You know, there are others as well. And then the question about the value of the federal historic tax credits. The other kind of more recent example in Hawaii is the Kunia Village affordable workers housing project in Kunia, and that was 48 individual homes, and I believe they got close to 100% on the dollar. And so I think it just depends on the nature of the deal, and you know how that works. So Mark Hasham's going to talk us through a case study that did combine both credits, the federal historic tax credit as well as the low income affordable housing credits for a project in Chinatown. So Mark. Really? This is the advance.
There you go. Aloha, everybody. My name is Mark Hasham. I'm with the ownership group, the development side of this. So as John's slide showed, we have 0.01% of the project, but hold all the liability. So there's something unfair. But anyway, going forward. So this is the Hocking building. So this, if you're not familiar with it, it's on the corner of King and New on a street right up the street from here. And the biggest question that I get from everybody is, why Hocking? What is Hocking, right? So Hocking is, the building is named after Alfred Hocking. He was a prominent businessman in the late 1800s and early 1900s here in Hawaii. He actually started off on Maui, and he was a Republic of Hawaii senator from Maui back in the late 1800s. In 1899, he moved to Honolulu. He started up Honolulu Brewing Company, better known as Primo Beer. And that his first building was the red brick building in Kaka'ako, which HCDA currently occupies. Then his next building was this building, the Hocking building. And if you can see it, it actually looks like two separate buildings put together, and it actually is. So on the left-hand side, the pinkish beige building is the actual Hocking building, and the right side is the Aseu building. So the story behind these two buildings is that when Alfred Hocking started building the building, he went to Mr. Aseu and he wanted to buy the new Nuuanu building, but he didn't want to sell. So he just started building his building on the King Street side. Well, halfway through the construction, all of a sudden, Mr. Aseu comes up to Alfred Hocking and says, okay, I'm ready to sell now. So he buys the neighboring building and he chops off the corner. So his building comes out to the corner, and the Hocking building now occupies the corner of King and Nuuanu, and he unifies the two buildings. So when you're walking inside the building, it's seamless. You can't tell where one building starts and where the other building ends. But as we go through the slides, when you see the floor plans later on, you'll see this weird configuration, and that's because of this whole history that happened in 1916. So the Aseu building was built in 1886, and the Hocking building on the left side was built in 1914. So. Next, this is just the characteristics of the building. It's a 40-unit rental apartment. It's on King Street. The land is roughly 15,000 square feet, and you can see the first floor is 12,500 square feet, but the upper floors of the third floor and the basement are 8,500 square feet. And that's because of the odd configuration of trying to merge these two buildings together. This is a little bit more characteristics of the building. It's outside of the floodplain, it's outside of the tsunami zone, and it's outside of the sea level rise. So this is the location relative to downtown. And note the address. It's 2 North King Street. So back in the day, in the 1800s, the main arterial to get from Kailua, the windward side, to Honolulu was Nuuanu Avenue. That was a road that went tied the two, I guess, cities together. And that ended right by King Street, or by the water. So one of the primary locations in downtown, the 1800s, was King and Nuuanu. So that was the center of Honolulu. So everything north of King Street is North King. Everything south is South King. So that is the center of Oahu at 100+ years ago. This is where the Hocking building stands relative to Chinatown Special District. And one thing, when it was originally built, it was called the Hocking Hotel. So it was to hold people, it was used as a transient place where people could come and stay. So it was actually residential. It was originally residential that was converted to office space. And now we're converting it back to residential. This is the makeup of the building. On the first floor, there's 6 units, second floor 21, and third floor is 13. Total of 40, and there's 1 manager's unit. And if you can see on the floor plan on the right-hand side, we have a community space. And then the community space too is actually the gym. Next to it is the laundromat, and on the Nuuanu Avenue is the leasing office. And we did this on purpose because to stay with the Chinatown special district feel of commercial space on the first floor. So one criteria for Chinatown is that commercial uses, one criteria is to use for the first floor to be commercial rather than residential. So to keep that same feel of commercial, we put all the commercial type uses facing the Nuuanu side and the King Street side, and we put all the residential units in the back of the building. So that's why the configuration is this way. The upper floors, the second floor is tied to the Aseo building, so it's roughly 12,500 square feet. But on the third floor, you can see that little finger like sticking out, and that's the area where Alfred Hocking chopped off the Aseo building, so that way he can get the corner. So his building sits on the corner. And like I said previously, it's a total of 40 units. 4 units are at 30% AMI. The rest of the units are 50% AMI. And we picked this on purpose. For LIHTC, you just need to be below 60% of AMI. But AMI means area median income. We intentionally picked a lower AMI because of like what John said, the unit configuration is a little bit different from normal. And one, there's no parking. So because of that, we picked a lower AMI. And the rents range from $650 for a studio up to $1,350 for a 2-bedroom. This is our tax credit equity. So we got a total of $10,500,000 in tax, low income housing tax credit. And after syndication, we got, for the federal, we got 85 cents on the dollar for that. And that equates to roughly $8.2 million. For the federal, we got roughly $7 million in light debt credits, which equates to roughly $6 million. State, we got 65 cents on the dollar. So at 3.5 million comes out to roughly 2.3 million dollars. The historic tax credit, we also got 85 cents. So we have $4.3 million worth of historic tax credit, which comes out to about 3.7 million. And as you can see, the Hawaii State Historic Tax Credit is 0. And the reason for that is this section right here in the HRS. It's 235-110.97B. That section in law, that one section in law doesn't allow us to decouple the ownership interest from the tax credit. And so this is exactly what it says, the caution. And for further explanation on that, I will leave it up to John. So when you guys, if you don't have it, if you want to ask questions, John will answer that. He's the tax expert. But so going back, when you go to the legislature this year to review the tax credit, make sure you get this removed so that way we can actually use it. Oh, going back one more, since there was a lot of questions on tax credits today, I'll go back. I think rather than getting a historic tax credit, you guys should get a state grant. It should be a grant program. And the reason for that is for the state tax credit, it's 65 cents on the dollar when you go to syndicate. A grant is 100% cash infusion into the project. The state budgetary impact is still 3.5 million, or the state budgetary impact is the same. So they're calculated as the same. However, it's less to the project. So if you're going to go
It's an inefficient delivery system.
very good. It's an inefficient delivery system. So, but on the state level, it's a same budgetary impact, the same. And challenges. So the big challenge was we did this in the middle of COVID, and that was really challenging because a lot of the state departments were closed. And as you can see on here, it says remnant parcel. So while we're going through the process, all of a sudden, our surveyor says, hey, your building's encroaching on government land. And I looked at him like, how the hell can we? This building's been here for over 100 years prior to this state. How can this thing be encroaching on government land? Right? So he said, as we researched it, back in the 40s when King Street was widened, for whatever reason, it created a 2-foot parcel by 100 feet long right underneath the building. And nobody knew that because we had no idea that it existed until the surveyor went out and found out about it. However, since we're in the middle of COVID, that was right when EGA shut down all the government agencies. Bureau of Conveyances was closed. Nobody could go in. Our surveyor couldn't, this is pre all the stuff that's online. So our surveyor couldn't go into the department to research this and to pull up all the old documents. So we had to wait 6 months till he could get access back into the Bureau of Conveyances to research all this stuff. And also, the next line there is IRS regulations timelines. And this is a 9% tax credit, so it comes with strict IRS deadlines. And yes, as the government was shut down and we couldn't do anything, our timelines kept moving. So, yeah, it looked really dire at some time, but then luckily, the IRS or Biden came out and extended our timeline. So we have a 10% test. When you do a 9% tax credit project, it's called the 10% test. You need to spend 10% of your project cost or your basis within 1 year of your tax credit allocation. Well, our 10% test is roughly $3 million. And we couldn't meet that because of the COVID challenges. So the IRS came in and not just for us, but for everybody across the nation, they extended the 10% test out a year. So that gave us some cushion. Then the next deadline is our placed in service deadline. The building has to be placed in service by December of 2024. So January 1st, that building has to be, January 1st, 2025, that building has to be ready to be occupied. And originally it was 2023. We were fortunate that the IRS came out again and extended our placed in service deadline. So, but now that COVID's over, we're not going to get another extension. So we have strict timelines that we need to follow. And as you all know, during the COVID period, there was construction overruns, right? Cost inflation, our budget went up by 30 some odd %. So it really put a strain on everything. But the one good thing that I can say is the historic tax credit. It's based on your basis and how much you spend. So our historic tax credit went up roughly $1 million. So that was a good thing. And that's it. I'll leave it up to questions. Yeah. So these are the things.
So in total, you were saying that we netted about $8.2 million in tax credit equity. How much of the total development cost of that?
How much? That's what.
Tax credit equity divided by total development costs.
The total development cost is about 32 million. So.
So about a quarter.
Yes. So, yeah, yes. Any other questions? Sure.
When is the expected completion for the renovation of that building?
So we need to get our occupancy permit by September of 2024. So we're under construction right now. The walls are in. Yeah, the walls are in. We're gonna walk through the property later on today if anybody wants to join. Yes, but we need to get the occupancy permit by September of 2024. So that way we can start leasing up the building and it has some cushion for us to place it in service. So good. Any other question? No? Okay, thank you.
Thank you, Mark. We wanted to spend a little bit of time talking about like handy hints, best practices, things that will help you be successful. So we're going to have John Sandor come back, and from his perspective of doing this over, I can't remember how many years, 25 years. What are some of the things that you should know before you start? So we'll run through that, and then we're going to have all of our speakers come up and we'll do a panel Q&A. So let's see, so tips and recommendations, how to be successful.
I think we covered a lot of this already, but we'll just reiterate a couple of things here. The one thing that I said already, but I just really want to drive home is start as soon as possible with the documentation process. And you need the part one, which is really easy to do if it's just in a contributing district, if it's just contributing building to a district. And according to the regulations, you have, before you finish your project, you have to at least build out the part one. Now you're taking a big risk if you do the work before you do the part two, but at the very least, send it to part one. That's the, otherwise, if you finish your building and you haven't even sent in a part one, you're out of the ball game altogether, unless the building is individually listed. And if it's individually listed, that rule, you're out of, you're in safe harbor for that. Use, and then as we reiterate, I'll reiterate what we said before, you can have two parallel tracks going on. You can have the listing and the certification of the rehabilitation. They can be going on parallel. You don't have to wait till one is done to do the other for the federal credit. There's a shorter window for getting it done for the state credit, but you still can get started with your rehab even if the project is not yet listed, assuming it's going to be an individual listing or even a district. As long as you've gotten the go ahead that it is eligible to be listed. So, and if you're working on a project and you think like, oh, I don't know if I'm going to do this or not do it as a credit, at the very least, take a lot of pictures. We cannot judge whether what you've done is acceptable if we don't know what you had to start with. Well, we don't use film anymore. It's pretty cheap to store a bunch of images on your computer. So if there's any chance that you might do it, don't lose that opportunity, because we get projects that come in and like, oh, they didn't take any pictures. Like, well, how do I know that there wasn't a wall there that you tore down? I don't know that. And I can judge these things only up to a point of reasonability. So you really want to use the documentation process in your favor, and don't try to take the pictures in a way that you realize, as we talked before, we're interested in that which is most important. We still get pictures of toilets, of bathroom tile. Like, we're not making you keep the bathroom tile. We're not. The more important the space, and the more you're changing something, the more important it is to document it. Like, 2 pictures of the basement is probably enough, unless it's some bank vault or something. Picture of the attic, 1 or 2 is fine, probably, unless you're trying to justify what the roofing was and we're looking at the backside for evidence. I mean, just think about why you're taking the picture. You're trying to explain to us what you're doing, why it's okay, and so you're going to make that case. If you have a building with a lot of cool stuff in it, I had a project years ago in St. Louis. It was a big apartment building, and some of the apartments had nice plastic cornices, they had fireplaces. Well, they took pictures of all that stuff, but they didn't take a picture of any of the other apartments. Well, I assume that all the apartments have plastic cornices and fireplaces. Sometimes it's as important to prove what you don't have as what you do have. So, keep that in mind, because otherwise I'm like, well, you showed me all these plastic cornices. I expect plastic cornices in every one of these apartments. And, then they claim, well, they weren't there. Well, how would I know? So just think about your documentation. You use it in a way that, imagine that you know the building. You're working on it, you're living with it. We don't. We're looking at photographs and orienting them to a photo key and to a plan. Even if it's just a sketch plan. You don't have to have an architect draw it up. If you're not changing walls or moving things, it don't need an architect drawing plan. You can just sketch it up yourself, just so that we can kind of understand the spaces there and the relationship of the parts. And when she was talking about the warehouse, I kind of skipped over that. I really wasn't aware of how it played out in terms of the designation. But if you are listing something for the sake of the tax credit, a building like that warehouse has a real dilemma, because they don't want to list it for, with a lot of intrusive stuff on it, like that awful addition on the front. So sometimes then the tendency is to start to make a case that that's important, because then it doesn't lack integrity, because that's part of its integrity if it's the 60s or 70s addition. But then if you want to tear it off, you kind of have a problem. You've made a case that the change is important, and now you want to undo that change. So when you're in the process of listing something, think about how that's going to affect what you want to do. And you can, by the rules of the National Register, you can uncover integrity, but you can't recreate it. I could use an example here, but I was accused of being sexist when I said it last time, so I'll skip that today. But there's some things you can't go back and reestablish once they're lost. You can reveal them by taking away things that show what was there. But if the building doesn't have any windows, putting windows in it isn't going to give it more integrity. It may give it more character and be something you need to do as part of the project. But it's not, it shouldn't be, your review board shouldn't, I'm not saying that it wouldn't be, but should not be influenced by the fact that you made it look better with new stuff. You know, that's not the way the National Register process works. So you have to realize, you have to work with what's there, what's original, and sometimes peeling stuff away, uncovering windows, uncovering walls that have been taking off bad additions, all those things can improve integrity. But putting back stuff is part of the rehab, but it's not part of what makes it eligible. I think I went over most of this. Just focus on what you're saying so that you're telling us what we need to know, not just random stuff. And it's certainly use an amendment along the way, even if it's very quick now with the electronic stuff. And we do try, you know, we really try to stretch to make sure that if you're using a building in its original function, that you get a little more leeway, that, you know, that it's the ideal use of the building. So things that are staying in industrial use, sometimes there's a lot more reasonability to letting them be changed more because industrial processes and so forth change. And standard one, which is basically says, use the building for a use that's appropriate. Sometimes it's just not appropriate, as you said before, to put certain things in certain types of buildings. This is the example of like, this was what the building on the right looked like. And this was outside the period of significance. So this was not a contributing building to the district until that cover was removed. And then when the cover was removed, the integrity, there was enough integrity left, it was revealed by that change. And this is the dilemma. This was a little rural Missouri town that they didn't like this storefront. You know, they wanted it to look more like the period of the building, but we didn't have any idea what the storefront was like. And the period for the district included the date the storefront was put on. So they kind of were stuck with keeping it because it was within the period of significance. And to take away real, tangible historic fabric, even if it wasn't ancient, was inappropriate if we had nothing to know what to put back. It would have been a speculative, generic storefront. And instead, we had what eventually someone will think is kind of a cool, early modern storefront with its asymmetry and its interesting materials, all of which were in great shape. So you do have to think about that period of significance when you're listing the building, and if it's already listed, pay attention to what it is when you're planning your rehab, that you don't just edit back to an earlier appearance. That doesn't mean you can never do that. And sometimes the earlier is important, but it's really hard to take away something when there's nothing underneath there to reveal, and you're gonna have to make up something. But that's not the goal of the program. We're really looking for trying to sustain real material. So that, just again, we have a lot of information online. Please try to wade through it a little bit if you're going to do a project. There's a search function, so if there are things that you're particularly curious about, look at those. There's some sample how to do a tax documentation project for different types of buildings, like a small commercial building, an individual single-family house, to kind of walk you through it step by step what we're looking for. So if you're doing it yourself and not hiring a professional, these big projects often hire a professional, but then those people charge you money, and that's money out of your pocket. So, you know, it's designed that someone should be able to do it, especially if it's not a multi-million-dollar giant project, that it's not, you don't have to hire somebody else to help you prepare it. It's credible. So I think I've said enough. We'll open it up to everybody.
So I'm going to invite all of our speakers to come up. Just pull a chair up and you can line up right here. Well, I guess you could stand if you want to, but we're going to talk for about 20 minutes. Let's see. We need to see if there's any questions online. So Andrea, are there any questions online? No. Okay, so people who are watching us on the webinar, feel free to put any questions in the chat, and Andrea will let me know if we get any. And we will also ask people in the room to use the microphone that Andrea's going to run around to you, or Michelle will actually, because Andrea's going to monitor the chat. So before we open it up to other questions, I think Mark had a question for John.
Yes.
So, let's give you the microphone. Michelle, will you give Mark the microphone?
So my question to John is, windows, it doesn't have to be exactly the same type of, if it's wood, it doesn't have to be wood. You change that criteria a little bit, right? Even in our project, so please explain that.
Well, we have a series of publications called preservation briefs that talk about different topics, whether windows and storefronts and roofing. And I just was working with a couple of colleagues. We just rewrote the one that had been out there for like 30 years and was quite out of date in terms of what it says. So if you read standard 6, which talks about replacement of material, it says that it shall match if it's too deteriorated to repair. It says, if possible, it should match with material. But it also gives some leeway in terms of whether it's a distinctive feature or not. So if you don't have the windows, like when, in the warehouse building, where there were steel windows that they uncovered, they repaired them, great. On the front, they were gone. Had they wanted to do an aluminum window that was very close, if not exact, and it wouldn't be exact because aluminum is not as strong as steel, that would have been perfectly acceptable under the standards. We would have accepted that. For your building, did you have historic windows in place?
They're all burned.
Right, so they didn't have windows. So then there was no window to match. When something is missing altogether, like a storefront, for instance, is typically gone because those things change over time. Then we look at the building and use our best judgment from looking at thousands of historic buildings of similar place and time. What would be a compatible storefront? What are the general characteristics it must have? Or a window, what would be the general characteristics? If it's a hung window, like 2 sashes that have an offset, certain relative proportions, surprisingly how similar windows were from 1850 up until 1950. They didn't change a lot in terms of what they looked like, no matter who made them. The details were often quite minimal. And so we're looking for the generic solution. And the generic solution can sometimes be accommodated in other materials. We don't say no to vinyl windows because they're vinyl. We say no to vinyl windows, at least up till now, because they have profiles that are distinctively different than a wood window. And a lot of aluminum windows have profiles that are distinctively different. And even the modern manufactured wood windows, if you say, oh, used to be, if you'd say, well, it had a wood window, put in a new wood window. And chances are you're going to get pretty close. Well, today, the industry, the way things are manufactured and efficiency and operation and everything else, the new wood window will not even look in terms of profiles and distinctive features. It won't look exactly like the historic wood window. And so when you don't even have the window left, then there's a little more wiggle room as to what that window can look like. It's one thing if you're replacing a window that you probably could have repaired and you didn't want to. Well, then the bar gets a little higher. Like, well, if you have to replace it pretty much exactly, you have to go to a shop and have somebody make it. Then maybe you decide to repair the window. But when the window's gone, we routinely see for wooden windows, we're seeing aluminum clad wood windows. And if the interior is gone, then we're often seeing all aluminum windows. But the all aluminum windows we're seeing are not the cheap ones. There are companies that make aluminum windows that can actually have some of the profiles that every bit as good as the wood windows. They just don't look as good on the inside if they're like, if you have a beautiful paneled interior with nice wood grain, do you really want a white enameled aluminum window in the side within your wooden frame? I mean, you have to then judge like, well, is the interior important? Maybe we need to stick with a clad wood window than something that has the aluminum on the outside but has the wood on the inside. So it's hard to make up rules for any of this stuff. It really depends on what you have, how important is it to the character of the building, and then what are the options. And when it comes to windows, I deal with windows pretty much a lot for the whole office, and we talk with window companies regularly. They come to talk to us when they're going to make a new window, and we give them feedback. So in the 25 years I've been at the Park Service, the choices we have for window replacement are infinitely better than what they were at the time, because the window manufacturers realized that, last year we did $6 billion worth of historic rehab work that came through, was reviewed by our office. We're a market that's worth paying attention to. So they're gonna make a new window, they'll come and ask like, well, if we do it this way, are you gonna more likely improve it? And so we have better choices now in materials. And we realize in these, a lot of, like in Florida, where there are termites everywhere, and here where, it's moist and hot, and a lot of wood doesn't last, especially a new growth wood. So we're not, substitute materials are a reasonable choice in many cases. Just not, it's not a blanket approval, but it's not by any means a blanket disapproval. So for Mark's windows, because they weren't there, we looked at like, well, what would be the basic form the window needed to have, and could we do it in a material that would be reasonable for their project? I have a question for John, though. You talked about the partners at 99%, but if I owned a building, like I'm gonna sell 99% of my project, explain a little bit the fact that like the 1% still is the one that manages, correct? And then ultimately, they're often in some of these projects, especially ones that are just historic, there's a point where the investor is out of the project and it's back to the original developer, correct?
Yeah, that's correct. So the general partner, and also kind of Mark mentioned, that kind of carries a lot of the risk, and all the risk and guarantees. And although they only own 0.01%, not everything has to flow based off of ownership percentages. So for example, cash flow. If a project has available cash flow, that actually can get distributed out, disproportionate to the ownership percentage. So we normally try to structure deals where the developer gets 90% of all cash flow. That kind of goes to incentivizing them to make sure that the project is running well over the 15 years we're in it. And then at year 15, when the compliance period is over and there's no risk of losing any low-income housing tax credits, then that's when we're okay kind of exiting the deal. And that's when it gets a little complicated, because when we go through partnership tax law, and you kind of have to go through the math of how all that stuff works. But ideally, at year 15, that's when we have a discussion with the developer on how we exit, and the developer can then retain the ownership of the project.
And if it's a historic credit, that could be as little as 5 years.
Correct, yeah. So you kind of have to follow the recapture periods.
Thank you, John and John. Questions in the room? Sorry, by making you wait till the end, you're like, oh, what did I want to ask? I forgot. Well, while you think of your questions, we did have some questions earlier on about some of where you can find additional information. So because I'm in control of here, I'm going to do some show and tell here for the Historic Hawaii Foundation website, because we do have some of the resources up there. So to share screen. Okay.
I have a question for John, please. Question for John. You were saying earlier that you have projects around the state, quite a few projects in Hawaii. Can you talk about the distribution across the islands as to where those projects are held?
Yeah, we closed, I think today, 22 properties in Hawaii. Not all of them are fully placed in service or constructed yet, but I feel like maybe 16 to 18 of them. And they're pretty evenly distributed amongst 3 of the islands. Oahu, the Big Island, and also Maui. We have about like 6 to 7 properties each. We're closing our first one on Kauai, hopefully early next year. So then we kind of got all the islands captured, but about 6 to 7 on each island.
What I'm showing, I hope both online and in the room, if I did this right, is historichawaii.org. And in these tabs up at the top, there's one called resources. And if you go down to resources to called funding sources, this is where we have some of these programs. So most of these are grant making programs. I know there's some nonprofits in the room that have some historic properties, and so there's information on how to apply for grants for that. But there's also here a link to John's site, John Sanders' site, the federal income tax, a link to the Hawaii state tax, and also to the local property tax exemptions, because we had a lot of questions about the property tax reductions for each of the counties. So on Oahu, there's both residential and commercial. And on all of the other counties, they have residential only. So here's where you can find additional information. Historic Hawaii Foundation does not run these programs. These are just links to outside sources, but it is a place where you can go to find that. And then the other thing I was going to show you was on our events tab. There's a drop-down menu called past events. And this has links to prior webinars. And so recordings when we were doing this all virtually, not so much like this, but it has some of the other topics we've talked about, like how do you know what historic integrity is? How do you know how to document character defining features? How do you know how to research the history of a place? So this is and these videos are also on our YouTube channel. So that may help for those of you who are asking where to get some additional information as well. Question here.
Sorry, this is for John. So could you just repeat what the QRE stands for?
I think John Sanders probably.
Qualified rehabilitation expenditures. And if the IRS has put up a whole series of questions and answers that's actually on our website, that under the IRS questions and answers, you'll find the information they have put up interpreting their regulations in as plain English as possible. But those are all the costs that are eligible for the credit. And they're certainly all the parts of the building that are permanent, as Jessica said, that wouldn't shake out if you turned it upside down. But they're also, they can be construction period financing. They can be your architect's fees. They can be a lot of soft costs as well that can be eligible to take the credit on. It's not just the bricks and mortar, but it can be stuff that, but look at it's defined. There's some things that still, like if we got questions about that, like somebody doesn't really have a good answer for about the septic system or something. It's really essential to the building, but it's outside the envelope of the building. Additions though, anything you do to expand your building, whether it be on the roof or on the side of the building, new construction, though it can be part of your project and we are subject to our review, is not an eligible cost. Site work, driveways, sidewalks, we might review that because it's part of, it can affect the character of the site that, though it's subject to our review, it's not subject to the credit, to computation for the credit. But that's where, you know, an accountant would be helpful because we're architects and architectural historians. We're not economists. We don't check that stuff. You know, it's not, some states though do. And then that stuff gets put down and they may make a decision that is determination that is different than what the IRS, because the IRS is like, who knows what they do. It's a little obtuse sometimes. If there's a big issue, you can get what's called a letter ruling from the IRS, but that takes time and money for if it's really critical to your project, but it would be a big project, but that would be applicable for.
So in terms of QREs for the state credit, our definition is the same, so there's no real change in that. We may have, the state has the ability to not implement, I'll use that word, the Secretary of the Interior standards for rehabilitation as strictly as the National Park Service is sort of required to. We can take a little bit of a liberty with our interpretation. So in specific instances, for example, recently we had a residential property apply for the state credit and they had an exterior, I'll call it a patio for want of a better word, but it was, you could tell that it was intentionally meant to be a living, part of the living situation, as is common here in Hawaii, where we have exterior living spaces that are like a room that's like an extension of the house. And under the federal program, if we were to use those standards, a lot of what they did might be identified as landscape features, but here in Hawaii, because of our custom of living, it's more seen as an extension of the house. And so we take liberties in those situations to say, yes, this is outside, but no, this is actually part of the house. And so we'll qualify as that as a QRE. And so I know it adds a layer of nuance and complication at the state level, but the definition in and of itself is the same.
I want to take your job.
Another question on QREs. So foundationally, similar discussion on moss rock walls and foundation materials for older residential homes. Would that be considered a QRE?
If it's part of the building, it's a QRE.
Yeah, I think and for the state credit, yeah, it's a QRE if it's part of the home for federal and state. If the federal credit would recognize that as being a landscape feature though, if it's not a part of the home, there might be wiggle room on the state side, depending on what it is, to be considered an extension of the home or part of the home.
Okay, then at a federal level, how about security walls, same material?
Fences, retaining walls, sidewalks, no landscape feature that's not a physical part of the dwelling.
Of the dwelling,
The building. It has to be part of the building.
that really helps, thank you.
Sorry, minor question just to clarify. So when you say a part of the building, if it's a stairway leading up to the building, is that considered landscaping or part of the building? Because it's listed upon the historic relevance of that stairway, but it's not necessarily inside the dwelling. See, it's a little gray.
Well, no, it's not great. Like you got a front porch, the porch is part of the building. So if you have a stairway to the front door, that's still part of the building.
What if it goes down a hill? So it's a great.
If it's not connected to the building, then it's not part of the building.
Okay. Your question?
All right, I'm impressed you all stuck with us for 3 hours. Thank you so much. Pretty exciting. Again, I know this was a lot of information, but I really want to thank all of our speakers. So John Lee, Mark Hashem, John Sandor, Kelly, wait, did I get that right? Shelby Mendez and Jessica Plough. So thank you all. All of our speakers need to stay right there because Andrew's going to take a group picture. For everyone else, we would again remind you to complete your course evaluation. Those who are online, you'll get a separate pop-up web page with course evaluation questions when you log out of the Zoom. And if you are going to be getting the AIA credit, if you're online, you can complete that as part of your evaluation. If you're here in the room, make sure you sign in on that sheet. And what?
I just signed it. They did.
And if you did not sign in when you walked in the door, make sure you sign in so we have a record of who was here. So for AIA credits, we will consolidate all that, submit it to AIA Honolulu, and then they will process it. Okay. So I just want to thank everyone. Again, our partners today were Historic Hawaii Foundation, the State Historic Preservation Division, the National Park Service, and our featured matter experts. So thank you, everyone. We're really excited you were here. Mahalo.
Lots of